This is Audible.
Best loser wins. Why normal thinking never wins the trading game. Written by a high-stake day trader. Written by Tom Hugard. Narrated by Richard Faymanville. Dear Markets, from the moment I first came across you, I have been fascinated by you. I probably even fell in love with you. I was too young to know what that meant, no more than 10 years old. You were featured in a national newspaper, a competition of sorts. I was too young to play with you, so I observed. Time was not on my side. I was born a few decades too soon to participate in trading like it is possible today. I had to go and live my early life, and you went about yours. When you went through the devastating bear market of 1973, I was just learning to walk. When you roared with anger during the crash of 1987, I was just finishing school. When you took the first steps towards the epic 1990s bull market, I was almost ready, but not quite there yet. So, you sent me a message that would change my life, and I took you up on the invitation, leaving everything behind me to pursue you. I studied you at university, 2 degrees in fact. I toiled for hours and hours trying to understand you through the eyes of the conventional economic thinkers, through the eyes of Nobel Prize recipients, and through the eyes of well-meaning journalists and experts. I wish you could have told me back then not to bother. You are not an equation to be solved. You are far more complex than a model could ever capture. Over and over you prove yourself to be the elusive mistress that no one ever truly understands. You are everywhere, and you are nowhere. Universal laws do not apply to you. My love for you was deep. You gave me so much joy. I gave you my all. You were there when I woke up, and you were there when I went to sleep. You have elevated me when I was fluid, rewarded me beyond my wildest dreams when I was flexible. You have punished me when I was rigid and stubborn, taking all your gifts back with interest. And boy, did I pursue you. I pursued you like a love-struck teenager. I approached you from all angles, from Fibonacci ratios to Keltner channels, to Bollinger Bands, to Trident strategies, as well as mythical vibrations of Gann and Murray math. I developed models of the tide swell in the Hudson River to see if you responded to that. I printed out thousands and thousands of charts, applying lines and circles, trying to find a way to dance with you so that my feet didn't get stamped on so much. I had sore toes, my love. Sometimes my toes were so sore that I had to go to the beach and just throw stones in the water for hours on end, angry that you didn't want to do the tango with me. You gave me sleepless nights. You gave me tears in my eyes, anger in my body, hurt in my soul, and yet I couldn't let you go. I knew there was more to it, and I knew I had to keep looking. I gave you everything because you made me feel alive. You gave me a purpose. You gave me challenges so hard even a drill sergeant would have to give you a nod of respect, and I will always love you for it. You kept me on my toes, like a parent wanting only the best for their child. But you made the lessons obscure. You designed it to look easy, but it was never easy. You made everyone believe that you could be danced with through models, through equations, through indicators, through conventional thinking, and through logic. But often there is little logic to you. And I struggled to dance with you for years, until one day, by chance, you told me your secret. You told me to stop trying to understand you. You told me to understand myself. I stopped trading. I took the time to understand myself, and I came back. And when I returned to the dance floor, you welcomed me with open arms, smiled, and said, "Welcome back. I see you get it now. Did you bring the Band-Aids?" And I did. Best loser wins. Preface. How you feel about failure will, to a very large degree, define your growth and your life trajectory, in virtually every aspect of your life. You may want to close this book and think about that for a while. It is quite frightening how deep that sentence is. What 99% of traders do not realize is that they are looking for answers in the wrong places. Knowledge of technicals, fundamentals, indicators, ratios, patterns, and trend lines, well, everyone knows about them, and everyone loses. Except the 1%. What do the 1% do that the 99% is not doing? What am I doing, enabling me to have the success in trading that I have, which the others are not doing? The answer is as simple as it is complex. I am an outstanding loser. The best loser wins. I have conditioned my mind to lose without anxiety, without loss of mental equilibrium, without emotional attachment, and without fostering feelings of resentment or desire to get even. It is because of how my mind works that I am able to trade in the way that I do. My knowledge of technical analysis is average at best. My knowledge of myself is what sets me apart. The true measure of your growth as a human being is not what you know, but rather what you do with what you know. I wrote this book to describe how I transformed myself into the trader I am today, and how I was able to bridge the gap between what I knew I was capable of and what I actually achieved. Introduction. My name is Tom Hugard. I am 52 years old. 30 years ago, I left my native Denmark. I wanted to trade the financial markets, and I wanted to do it in London. I had an idea of what I needed to do to become a trader. I got a BSc in economics and an MSc in money, banking, and finance. I thought I had everything I needed to become a trader. The right kind of education, a good work ethic, and passion for the markets. I was wrong. On paper, I was qualified to navigate the financial markets. In reality, educational qualifications mean little in the dog-eat-dog world of trading. This book describes the journey I went through to get to where I am today. Where am I today? As I type this, I have not had a losing day in 39 trading days. I run a Telegram trading channel, where my followers witness me make £325,000 in the last month alone, in real time, with real-time entries, money management, position sizing, and ultimately the exit of the position. No time delays, no lag, all done before their eyes, time stamped. This book dispels the myths of what it takes to be a home trader, or any trader for that matter. It has been a journey that saw me initially pursue the path that everyone else takes. A lot of books about a lot of indicators, patterns, and ratios, before finally realizing that the real answer to the elusive quest for trading profits was right inside of me all along. It truly was the last place I ever thought of looking. A promising beginning. After completing my university degrees, I started working for J.P. Morgan Chase. It wasn't a trading job, but it was close enough. Then in 2000, I became a home trader for a year and a half. It only lasted 18 months because I ran out of money. I had befriended the staff at the broker I traded with. They hired me as a financial analyst. I say analyst, but I was a glorified media whore. My mandate was to get the brokerage seen on TV, and my credentials were an understanding of technical analysis. I started that job in the summer of 2001. My first customer-facing experience was when the CEO brought me to Royal Ascot, a significant event in the social calendar of the rich and famous. It is a horse racing event mixed with champagne, funny-looking hats, and big cigars. Only the best and most lucrative clients were invited to this VIP event. On board the executive coach, taking the prestigious clients to Ascot, I was introduced as the new financial analyst. "Ask him anything," declared the CEO. One client asked me what I thought of Marconi. Marconi was a member of the FTSE 100. It had seen better days. It had declined from 1,200 pence to 450 pence over the preceding 12 months. "Do you think Marconi is cheap?" asked a pharmacist from Luton. I didn't know it at the time, but my answer, and a similar one on TV a few months later, would eventually get me fired from my job. Even if I had known, I would not have changed my answer. Marconi is garbage, gentlemen. Why are you chasing stocks that have fallen in price? The stock market is not like a supermarket, where it makes sense to buy toilet paper when there is a sale on. Sure, it makes sense to buy toilet paper at a 50% discount, but it makes no sense to buy a stock that has fallen more than 50%. Concepts like cheap and expensive may work in the world of Saturday grocery shopping, but not in the financial markets. My answer hung in the air like a morbid joke at a funeral. I had barely finished my verdict before I noticed the death stare from my boss. All these clients were long Marconi, and they would go on to lose fortunes. Later that year, I was on CNBC and I was asked to do a chart analysis of Marconi. By that point, Marconi had fallen to 32 pence from 1,200 pence, and still people were buying it. I suggested that on the basis of the chart pattern, Marconi would go to zero. A few newspaper outlets picked up on the story, and a few days later I was called to the offices of Sporting Index. The CEO wanted to ask me if it was possible to get these Marconi comments deleted from that internet. Marconi went to zero, and I was asked to find another job. Fortunately, City Index hired me the same day I left Financial Spreads. I spent 7 years on the trading floor at City Index. In 2009, I was made redundant, and I have been a private trader ever since. I have spent the last 12 years of my life perfecting my craft. I am what brokers call a high-stake trader. The average stake size amongst retail traders is about 10 pounds per point risk. I risk anywhere from 100 pounds per point to 3,500 per point. On volatile days, I have traded in excess of 250 million pounds in notional value. I once made a little more than 17,000 pounds in less than 7 seconds. One time, I lost 29,000 pounds in 8 seconds. That kind of stake size sharpens the senses. Yes, it is a great life when it goes well, but a very challenging one when adversity sets in. This book describes my journey from an unemployed financial broker in February 2009 to the high-stake trader that I am today. But it is not a conventional trading book. Just another trading book? The world does not need more trading books. So, I decided not to write one. I know enough about technical analysis to write a few books. I also know that technical analysis does not make you a rich trader. It doesn't even make you a good trader. I had no ambitions of wanting to write a book, but one day, while I was watching a documentary on YouTube, an advert appeared on my monitor. I recognized the face immediately. It was a guy who once attended a few speeches I gave on technical analysis while I was working as a trader at City Index in London. Now he appeared in an advert promising to reveal the secrets to the financial markets through his courses. The advert proudly declared that if you wanted to learn to trade like a pro, then this course was what you needed. As it happened, a friend of mine had attended the course. It took place over a weekend in some plush offices in London. The place was packed and the hopefuls hung on every word of this self-proclaimed guru as he took them through one chart after another. There was no critical thinking present. No one questioned his claims. Everyone left that office building on Sunday night thinking they would make a small fortune by the coming Friday. I saw the course notes. It was hundreds of pages of regurgitated material from the standard textbook on technical analysis. There was no original thought behind it. There were no new contributions to the field of technical analysis. Anyone with half an afternoon at their disposal could find the same material free of charge on the internet. More importantly, my friend told me the guru never missed an opportunity over the weekend to pitch additional products such as personal mentoring and the advanced course. Those who can, do. There is a saying that those who can, do, and those who can't, teach. I don't agree with that. There are many people who can and who also do. One is not exclusive of the other. Many great doers see it as part of their life mission to pass on knowledge to those around them. When I worked at City Index, I might not have been an oracle of technical analysis, but I certainly knew more than most of our clients. For that reason, I gave technical analysis lessons most evenings to our clients and the many white label clients that City Index had, such as Barclays Bank, Hargreaves Lansdowne, and TD Waterhouse. I truly enjoy passing on knowledge, and I did the best I could with the knowledge I had. However, what I didn't realize back then was that technical analysis is rather pointless unless it is combined with behavioral response training. My main beef with the many gurus teaching outrageously expensive weekend courses is their outcome focus. They are driving their agenda by the use of external stimuli, such as portraying themselves in a helicopter or on a private jet. And they portray trading as an easy profession to master, or one where there is a secret to be learned, and once in possession of this coveted secret, you become your own ATM. Rarely, if ever, will these gurus risk their reputation by disclosing their trades in real time. It is always after the fact. We never hear about their losing trades. This gives the illusion that losing is a mere inconvenience you experience from time to time when trading. It is only when you sit down in front of the screen on Monday morning, after your overpriced weekend course on trading, and the market is moving in front of you and you don't have the after-the-fact chart in front of you, that you realize this game is not as easy as the guru told you during the weekend course. I have written a book that is an antidote to all the rubbish that is being peddled in the trading arena by charlatans who are 99% marketing and 1% trading. They preach their message to unsuspecting people who sadly believe them, with neither the teacher nor the student realizing that they only got 10% of the story. More importantly, I have written a book which is all about the aspect of trading they never teach you, and how to get to the top of the trading pyramid. While writing this book, I saw an advert for a technical analysis course in my home country, Denmark. Only the year before, the person running the course had lost 35% of their trading capital on a copy trader account for their followers, before closing the account. That is the problem with technical analysis. It is very easy to learn, but it should not be touted as the path to untold riches in the financial markets. The gurus appear on adverts suggesting that all you need to make money from the market is to learn technical analysis. I wish it was that easy, but it isn't. If not technical analysis, then what? There is a law in Europe that states that brokers offering trading services to retail clients must disclose what percentage of their clients lose money. I looked up the major players in the industry. According to their websites, around 80% of their clients lose money. I called one broker to ask how this number was calculated. The number is adjusted quarterly. The broker compares the account balances of its clients from the prior quarter and simply takes the percentage of accounts that have a lower balance than 3 months earlier. If the answer to the trading quest was to study technical analysis, then you would not have default rates of 80%. Incidentally, the guru who gave a weekend course to my friend happens to also own a brokerage that he refers all his attendees to. I looked up its default rate. More than 80%. So either his clients are just awful traders, or he is an awful teacher. I will come to the rescue of both camps and state that to become a profitable trader, you need much more than just technical analysis under your belt. That is why I wrote this book, to describe the path I have taken to get where I am today. Over the last 30 years, I have read many books on technical analysis and trading techniques. I personally find most of them boring and pointless. All I see in these trading books is one perfect chart example after another. It creates an illusion in the mind of the reader. They absorb these conceited tales, written by traders who espouse the same material as everyone else, material that bears little resemblance to the real trading world. It leaves the reader blindsided to the reality of the trading arena. Of course, there are exceptions. There are some good books written on techniques and strategies, but most of them are garbage because the author suffers under the illusion that he or she should only show perfect trading examples. I dare say that if technical analysis as a subject was comparable to something like dentistry, the vocation would be terminated on account of the 80% failure rate. You don't have an 80% failure rate amongst dentists. The Million Views YouTube Talk. I was invited by one of the biggest brokers in the world to give a talk about the life of a home trader. They filmed the event, which lasted a few hours. I gave the speech a provocative title: Normal Does Not Make Money. The broker emailed me last year to say that my video had received 5 times more views than their second best video, and that it had now surpassed 1 million views on YouTube. This gave me confidence to push ahead with the book project, because I could see that my message resonated with an audience that wanted to move beyond the conventional teachings in trading. Although this is not a book about trading techniques, I am not arguing that you can do without technical analysis or some form of analysis. There must be some rhyme or reason to your entries and exits, and your stop-loss placement. However, I am also arguing that techniques alone will not make you rich. Analysis alone will not get you to where you want to be. I imagine you want trading to give you a meaningful side income, or perhaps even be your main income. I am arguing that a normal human being, displaying normal thinking patterns and traits, will never stand a chance of making money trading. In other words, normal won't cut it. One of the best books ever written on trading is Reminiscences of a Stock Operator. There is not a single mention of trading techniques in that book. Let's face it, we can all learn to walk a tightrope suspended 1 foot off the ground. However, can you walk across that same tightrope when it is suspended 100 feet off the ground? In the same vein, we can all trade bravely and aggressively when we are trading one lot. But can you trade with absolute clarity and emotional detachment when you are trading a 10 lot or a 100 lot? I can't guarantee you will trade 100 lots, but I will describe the process that got me to trade that kind of size. I am leaving no stone unturned. I have described every facet of life as a trader, from the mundaneness to the excitement, and I have described the exact steps I take every day, week, month, and year to ensure that I am up to the job. And let me immediately make an important declaration. I am not going to sugarcoat my message. It is an insanely difficult profession, one that is beyond the apparent mental abilities of almost everybody, yet at the same time a profession that will reward you with wealth beyond your imagination once you understand how this game really should be played. This book describes how to play the game of trading. Now you know the end destination. If you don't like the sound of it, now is a good time to put down the book and go to the YouTube and TikTok videos and watch the Ferrari-driving 20-year-old trading coaches tell you how it is all done. If, however, you want lasting change, not only in your trading, but in how you live your life, then stay with me. Your transformation into a consistent trader will permeate other parts of your life. It will give you a deep understanding of who you are and what you can do to better yourself. The end result is not just more money on your trading account, but a more harmonious and exciting life journey. Liar's Poker. My journey as a trader started when I came across a book called Liar's Poker. I was home from school with flu, and my dad brought me some books from the library. Liar's Poker was one of them. It is a period piece written by Michael Lewis, the man behind the book The Big Short, which was made into a Hollywood blockbuster. In Liar's Poker, Lewis describes life as a bond trader during the excesses of the 1980s. In his own words, it was meant to serve as a warning to future generations about the gluttony of the finance industry, as well as a warning to young people wanting to work in the financial industry. I think it had the opposite effect. I suspect thousands of young men and women like me read the book and thought to themselves that Wall Street was the place to be. The book describes a young man traveling from America to Britain to study at a London university and subsequently being hired to work for an American investment bank. It describes what it was like to work on a trading floor and observe some of the big traders there. I was hooked, and I knew trading would be my vocation. I have since read many other books that are perhaps more specific about trading than Liar's Poker, but as a starter book, I could not have asked for anything better. My life changed after reading that book. It was a wake-up call. I went from being a skateboard-loving football fanatic to being a focused and driven individual. I had found my calling. I started applying to university degree courses around Europe. I already had a job at a pension fund as an office trainee. After reading the book, I knew that would not be my end destination. I got accepted to a university in Britain for the following year, but I had a problem. There was no funding. I had to pay my own way. I worked all hours, day and night. During the day I would work at the pension fund, then in the evening I would skate 5 miles to an amusement park to work there until 1 a.m. I absorbed as much information as I could from the Danish finance pages. I would read English books to improve my language skills. My family was less supportive. On the big day of departure, I had to make my own way to the airport. They eventually came around and shared my trials and tribulations throughout the years. My sister once told me she chewed her nails the first time she saw me on TV. She was so nervous I would freeze on air. My first big trade. There is a saying in the financial markets that perfectly sums up my first brush with speculation. Don't confuse talent with luck. I was blind to the ways of the financial markets, but I got incredibly lucky. It was September 1992. I had just been accepted to my university. I had worked hard to earn enough money to finance the tuition fees and living expenses for 3 years, although I was a little short. I figured I would work through the holidays to make up for the shortfall. As I was packing up my home and preparing myself to journey to the United Kingdom for my first year as a university student, there was a proverbial hurricane blowing through the currency markets. The UK was a member of the European Exchange Rate Mechanism, ERM. This was a system introduced by the European Economic Community to reduce exchange rate variability and achieve monetary stability in Europe. The UK joined the ERM in 1990, but by 1992, the UK was in a recession. The Bank of England found it more and more difficult to honor their commitment to maintain the British pound within a tight band against other currencies in Europe. Speculators were actively betting against the pound, thinking that it was heavily overvalued. As I was walking to my local bank in Denmark with my savings, looking to exchange my Danish kroner for British pounds, a major drama was unfolding in the financial markets. It was called Black Wednesday. On 16 September 1992, the British government was forced to withdraw the pound from the ERM after a failed attempt to keep the pound above the lower currency exchange limit mandated by the ERM. I found the following information about Black Wednesday on Wikipedia. It sets the tone well for what I was about to experience and what caused a massive windfall for a 22-year-old aspiring trader. Soros's Quantum Fund began a massive sell-off of pounds on Tuesday, 15 September 1992. The exchange rate mechanism stated that the Bank of England was required to accept any offers to sell pounds. However, the Bank of England only accepted orders during the trading day. When the markets opened in London the next morning, the Bank of England began their attempt to prop up their currency as per the decision made by Norman Lamont and Robin Lee Pemberton, the then Chancellor of the Exchequer and Governor of the Bank of England respectively. They began buying orders to the amount of £300 million twice before 8:30 a.m. to little effect. The Bank of England's intervention was ineffective because Soros's Quantum Fund was dumping pounds far faster. The Bank of England continued to buy, and Quantum continued to sell until Lamont told Prime Minister John Major that their pound purchasing was failing to produce results. At 10:30 a.m. on 16 September, the British government announced a rise in the base interest rate from an already high 10% to 12%. To tempt speculators to buy pounds. Despite this and a promise later the same day to raise base rates again to 15%, dealers kept selling pounds, convinced that the government would not stick with its promise. By 7 that evening, Norman Lamont, then Chancellor, announced Britain would leave the ERM and rates would remain at the new level of 12%. However, on the next day, the interest rate was back on 10%. This was, of course, all unbeknownst to me, yet it had a material impact on my studies. Had I walked down to the bank just a few days earlier, I would have had to pay close to 12 Danish kroner for 1 pound. By sheer luck, I walked straight into and benefited from one of the biggest modern-day currency crashes, and I was able to convert my Danish kroner at an exchange rate of about 9 kroner to the pound. I made an extra £4,000 from my savings. My annual budget with tuition and lodging was £2,500. Uncle George made my university education debt-free. Although the day was called Black Wednesday, many historians argue it was a Golden Wednesday because the cheaper pound attracted investment. It set the stage for an economic growth spurt in the United Kingdom. The price for the hot dog in Paris. I wasn't the only one who made a life-changing amount of money that day. George Soros made $1 billion. It cemented his name as one of the greatest speculators of all time. And he wasn't the only one who had noticed stark value differences between the European currencies before that fatal day in September of 1992. Another trader had too. Actually, he wasn't a trader at all. He owned a printing company in East London. We shall call him the Englishman. When I started working in the city of London, I heard the story of a client who had been holidaying in France. During a visit to Paris, he found himself buying a hot dog at a corner stand down by the Eiffel Tower. When it came to pay for the goods, the price for the hot dog was so shocking to our Englishman that he was thinking the hot dog stand owner was trying to cheat him. He was assured that this was the prevailing price for a hot dog in Paris. He decided to buy another hot dog somewhere else, just to make sure he had not been cheated the first time around. The outcome was the same. Our Englishman was laying the foundation for one of the greatest single-man bets in the history of the retail trading industry. He walked into a supermarket in Paris and started making a note of the prices for food, drink, and other household items. Back in London, our Englishman compared the French prices to the prices for the same goods in his local supermarket, and he concluded that the French franc was hugely overvalued. He called his financial trading house and spoke to a young broker who was later to become my boss. My boss loved to tell the story of how his client managed to turn a £5,000 account deposit into an £8 million, that is £8 million profit. He relentlessly pursued the idea that the French franc was hopelessly overvalued, and he profited hugely from it. The reason for sharing this anecdote is not merely to tell you a good story, but also to prepare you for what this book is all about. You see, this might have been a great story had it not been for the fact that the client later went on to lose all of that money, and then some. Isn't successful trading all about making money and holding on to it as well? What 99% of people do not realize is that when you win, there are things happening in your brain chemistry which, if left unnoticed and unchecked, will have a detrimental effect on your decision-making. Economic theory and economic history. Studying at university taught me what there was to learn about economic theory. It taught me how the financial markets were put together and how current economic theory tried to make sense of the world around us. However, it didn't teach me how to trade. It didn't teach me how momentum, psychology, and sentiment have a major influence on the financial markets. My degree course did little to prepare me for the real world. I thought that taking a master's degree would change that, and while it was a little more industry relevant, I still felt the market was a big mystery to me. The idea that you can test variables within an economic system by holding other components constant didn't sit well with me. I am not sure I was consciously mindful of it then, but I saw the world differently. I didn't think that the markets were efficient. I had a strong belief that the markets were anything but rational. The markets are driven by humans, and if there is something humans are not, it is rational or logical when exposed to stress. Rich Man's Panic. I enjoyed studying economic history more than I enjoyed studying economic models. One of the pivotal moments came when studying the Rich Man's Panic of 1903 and the Panic of 1907. Bernard Baruch, a famed Wall Street speculator, made a substantial amount of money by correctly anticipating the consequences of a failed corner of a railroad stock. A corner is when a group of people or a syndicate inflates the price of a stock in order to create a buzz, thus trying to entice more gullible investors to join the bandwagon, and then offloads the stock to the latecomers. Today it would be called a pump and dump. Just think GameStop. What made an impression on me was how Bernard Baruch anticipated the sequence of events. He started to sell short a broad range of popular stocks because he reasoned that the syndicate would have to raise money to keep their ill-fated corner alive. He was right. The general market declined rapidly. The Dow Jones Index fell 49% in a few months, and Baruch profited from it. From then onwards, I found it difficult to study economic models. I found them rigid and too theoretical in concept. I felt they made fallible assumptions. They argued that humans always act rationally. But mankind most certainly does not always act rationally. As I write this page, I am looking at my quote monitor. The Dow Jones is called down 500 points. The DAX index is already down 250 points. Why is that? I hear you ask. It is because there is a serious virus called coronavirus spreading through the world. Some 80 people have died already. The market is not so concerned about the 80 people. The market is concerned it is going to get worse. The markets are all about perception, sprinkled with economic reality. I don't understand the fundamentals behind a virus, and I don't need to. My job is not to understand the implications of a virus. My job is to understand the players in the market and what they are feeling. They are scared, and I have spotted their fear. So of course I am short. I am not short the market because I think a virus is going to wreak havoc on the global economy. I am short because I think they think something terrible is about to happen. Whatever happens, my job is to read the sentiment and to keep my own emotions in check. That is essentially what I am going to teach you in this book. I am aligned with reason when it comes to explaining bull markets and bear markets. The health of the underlying economy will drive a market up or down. However, as a day trader, I need to have a mental flexibility that is never described or accounted for in economic theory. I also need to know when to hold and when to fold, as Kenny Rogers sings in The Gambler. Am I a gambler? If I say yes, you might think there is no difference between me and the guy who visits a casino for a bit of excitement. What if I were to tell you that I make more money than the average professional football player? And I do so, not because I am gifted with special abilities to read the markets, but because I have learned to control my emotions. I am not an unemotional sociopath. I feel. I love. I cry. I ache. I mourn. I laugh. I smile. You can be a nice guy and still finish on top. But you do need to learn to think differently than the 99% does when you are trading. We will get to that soon enough. J.P. Morgan Chase. After my graduation, I interviewed for many graduate jobs within the banking and finance industry. I didn't get my dream job working as a trainee trader, but I did get a good job working for Chase Manhattan Bank, later called J.P. Morgan Chase. It was an invaluable experience. I arrived with a bag full of enthusiasm. Working for an American investment bank was probably the best thing that could have happened to me. I was able to channel my enthusiasm for the financial markets into my work. I worked with portfolio analysis and performance benchmarking, which meant I was able to observe the financial markets unfold before my eyes every single day. I happened to sit right next to a Bloomberg terminal. I loved that machine. I would often sneak into the office building on Saturdays and Sundays to devour analysis and trading stories and download data. The great thing about working for an American bank is that there is a very different work ethic to typical European companies. This may have changed in the last 20 years, but when I was working at J.P. Morgan, we were literally allowed to work as many hours of overtime as we wanted. I worked for JPM for close to 3 years, and in those 3 years, I never had a month where I didn't do at least 40 hours overtime. You got used to working long hours with focus because the job required forensic attention to detail. By the time I left the bank, I was a hardened and seasoned workaholic. I don't say that with pride, but I don't think there is any point in hiding the fact that the reason for my success was not due to immense intelligence, but rather my work ethic. I just worked longer hours than the others. I made the sacrifice for what I wanted. My attitude reminds me of the ethos of the Navy SEALs, the American Special Forces Unit. Anything in life worth doing is worth overdoing. Moderation is for cowards. My dream finally did come true when I walked onto a trading floor for the first time. The trading floor. Walking onto a trading floor is a special experience. I vividly remember being interviewed for a trading job after my university graduation. This took place on the trading floor of Handelsbanken, the Scandinavian bank, and the guy who interviewed me was the head of trading. I could tell that he was intensely focused on something else, and I was an inconvenient distraction. I have been in that situation many times in my trading life. Having a big position on in the market and then having to deal with the trivialities of the world outside of trading can be a peculiar experience. Boxing Day 2018 is a great example. I was trading the biggest one-day rally in the history of the Dow Jones Index while eating Christmas pudding. I had to hide my mobile phones under the dinner table so as not to offend my host, and I had to fake numerous trips to the toilet so I could watch the chart on one phone and the broker platform on another. I arrived at the trading floor of financial spreads with a very different attitude to most of my colleagues. As I know many of them will read this book, I owe it to them to explain that I am not accusing them of being lazy. I had lots to learn, including the fact that when the markets are quiet, there really isn't much for brokers to do. What I found was that people would sit around and read the newspapers or comic books. If the phone didn't ring, you could hardly force a broker to do anything. I think this was the biggest culture shock I experienced, the contrast between a normal office job and a trading floor. Working on a trading floor is intimidating at first. As the months go by, you become immune to the money-changing hands. It is all just numbers on a screen. I once walked in at 6 a.m. to find that a Russian client was on a margin call for $10 million. I quickly calculated that it would take me 133 years on my current salary to make $10 million. By 7 a.m., he had wired the funds over. This was a private trader. I was in awe. Inspired. There is a unique atmosphere present on a trading floor. When it is busy, it is nothing short of a gigantic melting pot of human emotions. I once saw a colleague of mine kick his PC so hard, repeatedly, that IT engineers had to come and replace it. It is hard to fathom that the financial markets are a complex mechanism if you just look at what is happening on a trading floor. It reminds you more of a local market stall on a busy Saturday morning in any given town anywhere in the world, where one stall owner is trying to outvoice the next. When you witness the raw, uncensored emotions that unfold before your eyes on the trading floor, it is difficult to see how that fits into a finely tuned global economic environment that makes up the very fabric of our modern society and civilization. Impulse buying, panic selling, holding on to losses, refusing to admit defeat, greed, stupidity, stubbornness, despair, tears, abject depression, exhilaration, and excitement are all on display here, and all in quick succession of each other. I worked for Financial Spreads for a year and was then asked to leave. The same day I was headhunted to City Index, which was owned by ICAP, the biggest U.S. government bond broker in the world. City Index had about 25,000 clients, of which 3,000 were active most days. These clients would trade currencies, commodities, stock indices, individual stocks, options, bonds, and anything in between. I must have witnessed tens of millions of trades in my career, executed by thousands of people. Very few, if any of them, stood out. And if they stood out, it was for all the wrong reasons. For every success story, I can tell you 10 horror stories. No memory of the great traders. I recently spoke to a friend of mine who is the CEO of a trading company in London. I asked him if there were traders who had stood out during his 30 years working on trading floors. He said that over the years he had witnessed many bizarre things, but in terms of good traders, he had seen very few. Here is a man who has spent his entire adult life on trading floors, yet he is incapable of remembering people who did well. We are talking about a percentage of successful traders so infinitesimally small that it makes you wonder why anyone would want to trade in the first place, or if anyone could ever get good at this profession. The conversation with him went as follows. Tom: You have worked in the contract for difference, CFD industry, for 30 years. You must have seen some good traders along the way. Can you tell me about them? CEO. I wish I could. I have seen many people make a lot of money, but very few manage to keep the money. I started in the industry at a time when CFD trading was not a mainstream tool. It was mostly very wealthy people or people who worked in the industry that had CFD accounts. These clients back then often traded as part of an old boys club kind of network. It meant they mostly traded specific shares and some commodities. Back then, trading was nowhere near as prolific as it is today. Tom. Were they good traders? CEO. No, I would not say they were. We had clients who were well-known personalities in the city, and their personal trading was often atrocious, even though they were hedge fund traders or fund managers. It was almost as if they lost their discipline when trading their own money. I am certain they would not be allowed to trade for their clients in the manner they traded for themselves. Today we have far more smaller traders, but the pattern is remarkably similar between a small trader and a large trader. Almost all clients have more winning trades than losing trades. As such, you could argue that they are good traders. However, they tend to lose more, much more, on their losing trades than they win on their winning trades. Their ratio is that for every pound they win, they lose about £1.66. Tom. How does a CFD broker make money out of that? CEO. Well, believe it or not, we want our clients to win. I have a network of clients in the CFD industry. I regularly meet with CEOs of competing companies. Although we are competitors, and we would do anything to outmaneuver a competitor, we do have one shared wish. We wish our clients would trade better. We try our best to help them. We give them every tool under the sun. We give them favorable spreads, and we give them news services. We give them sophisticated charting packages. We give them data. We give them analytical tools to measure their performance. In short, we do absolutely everything we can to ensure they have all the tools they need to make money. And then we let them trade. The problem is that most smaller accounts tend to lose within a short space of time. Trust me when I say I wish it was different. I don't know what more we as brokers can do for our clients. We prefer clients to make money because there is clear evidence that those who trade and win carry on trading. That is better for business. The truth of the matter is that you can clearly see the difference between a consistently profitable trader and a normal trader. Their approach is very different. Tom. How can you tell whether someone knows what they are doing? CEO. There are a multitude of parameters that we may look at. If I have to narrow it down to the 5 most important factors, it would be these. 1. Account size. 2. Trade frequency. 3. Ratio of time spent holding winning trades versus losing trades. 4. Adding to winning or adding to losing trades. 5. Trading with a stop loss. Someone who opens an account with anything less than £100 will, with a very high degree of certainty, lose that money, sadly. Someone who trades everything and anything, i.e. overtrading, will eventually lose their money. Anyone who is unable to hold on to their winners, but holds on to their losing trades, will eventually lose their money. Anyone who adds to their winning trades will catch our attention, positively. But anyone adding to their losing trades will, with near certainty, lose their account deposit at some point. Anyone trading without a stop loss will follow that path too. We sadly see it all the time. As you can see, as brokers we do everything we can to help people make money. But people are people, which means they will find a way to self-sabotage. Conditions 20 years ago. I keep an eye on all brokers to make sure I trade with the best and cheapest. Why would I pay 1.5 in spread if I can pay 1 in spread? That is simple economics. I run a business and I want to spend as little on transaction costs as possible. One of my favorite instruments to trade is the German DAX index. Today when I trade, I pay a 0.9 point spread in the DAX. However, when I started trading some 20 years ago, the spread intraday in the DAX was 6 to 8 points. I remember vividly trading the Dow intraday. You had to pay an 8-point spread in the Dow for the intraday product. If you wanted to trade the quarterly contract, the spread was 16 points. This was at a time when the Dow was trading around 10,000. Today, I am trading the Dow with a 1-point spread, and the Dow is now trading around 35,000. You are much better off trading in 2020 than you were trading in 1999. It was much harder to make money trading back then. The market has to move significantly less in your favor before you are at break-even now, compared to 1999. Another major advantage that people who start trading today have is the tools available from the brokers. Look at virtually any trading platform today, and you will see the length brokers go to in order to help you make money. You have access to hundreds of technical studies. You have access to instant news flow. You have the option to be trained through online material and webinars. You have access to level 2 data for stocks all over the world. You have decent bid-ask spreads. If an institutional trader from 30 years ago saw the tools that you are trading with today, he or she would be green with envy. You have at your disposal every single conceivable analytical tool available from the vast resource pool of technical indicators. You have Bollinger Bands. You have Keltner channels. You have moving averages. You have tools that I have never even heard of or used myself. Suffice it to say, every broker in the world has spared no expense in their effort to provide you with every opportunity to make as much money as you possibly can out of the markets. But it matters nothing. Most people will fail. The failure rate is astronomical in the trading industry. No one is immune to statistics. Normal is a loser. There is something inherently wrong with the approach of people who are trading. We have to assume that most people in society are normal, well-adjusted human beings. Their pattern of behavior, while leaving room for personality, is most likely very similar. From cradle to grave, from morning to night, from one year to the next, the average person is engaged in a remarkably similar pattern. Pattern of thought, pattern of action, pattern of hopes and dreams, fears and insecurities. We call that person normal. If normal is the familiar pattern, and if normal is opening an account with a CFD broker and proceeding to lose the money sooner or later, then normal is simply a representative of everyone else. Everyone who is normal will end up losing. Is that a push too far? Let us look at the evidence. Let us take a look at the norm for a typical CFD trader in the retail trading space. Even though your broker makes all the tools under the sun available to you, no one is immune to the statistics of the financial markets. Unless you have gone through some sort of structured training, or you have been schooled by someone who is walking the path you yourself want to walk, or you give this endeavor some serious thought, you will most likely fail in the financial markets. Look at any broker website in the European Union, and you will see the failure rate. Brokers are obliged by law to post this on the front page of their website. Here are some of the biggest and most well-known CFD brokers in the world and their failure rates. IG Markets, 75%. Markets.com, 89%. CMC Markets, 75%. Saxo Bank, 74%. FX Pro, 77%. Rates correct as of 7 November 2019. I know you like to think you are different. However, in the eyes of the financial markets, you are statistically like everyone else. You can look at the top 10 brokers of the world and the statistics do not change. You can look at CMC Markets, you can look at IG Markets, you can look at Gain Capital, or you can look at any one of the top tier or second tier CFD brokers. No one will have a failure rate less than 70%. Normal is not good enough. Tools do not make you a top trader. Techniques do not make you a top trader. If you want to be a good trader, if you want to achieve the level of success that you know is possible, you immediately need to stop thinking that the path to riches in trading has anything to do with the tools or techniques you are using. Yes, of course you need a strategy. Yes, you need a plan. Yes, you need to understand the markets. So, what is this book all about, if it is not about tools and strategies? Well, let me address that question from a different perspective. Let me address it from the perspective of the people who work in the industry as brokers and sales traders and as marketing people. Do they trade? I would say it is likely they do not. Yet, traders are taking advice, guidance, and training from them. They are being guided by people who are no better at trading than they are. It reminds me of Fred Schwed's book, Where Are the Customers' Yachts?, in which he says that Wall Street is the only place in the world where people who arrive to work by train and bus give advice to people who arrive by limousine and helicopter. Slightly paraphrased for a more modern touch. Traders are being guided by people who can't trade. Wrong focus. When you go to trading shows, read trading magazines, or look at the online education materials on broker websites, 100% of the focus is on what I call how to. How do I scalp? How do I swing trade? How do I day trade? How do I trend follow? How do I trade the foreign exchange, FX, market? How do I use the Ichimoku charts? How do I trade with moving average convergence divergence, MACD, or stochastics? This is perfectly normal. The trade shows and magazines are geared towards providing the solutions that most people believe they need in order to make money in the financial markets. The brokers are following the same path. They provide the information that they think traders need and that traders think they need. Newcomers to the industry of trading are often guided by the very people who are likely to set them off on the wrong path. They are led to believe that it is all about technique and strategy. No one is preparing them for the fact that it isn't strategy that will set them apart from other traders. It is how traders think about their strategy and their ability to follow the strategy that will set them apart. Do you not wonder if this is the right path for you? Do you not wonder about the futility of dedicating all your resources to one pursuit when virtually everyone who walked that path before you has failed? You should. You really should ask yourself what makes you different to the 90% of traders that do not make money. If you are normal, as in you do what everyone else is doing, then you won't make it. Normal won't cut it. The organizers of one of these trade shows invited me to give a talk. This show was in London, and I was told I could talk about whatever I wanted. I decided to give a talk about the disastrous failure rate in the trading industry. My argument is that if 90% of all CFD accounts lose money, the problem is a human problem. I feel I am making a reasonable assumption when I say that everyone opening a CFD account is a normal person with a normal way of thinking. There must be something inherently wrong in the way normal people think and act that makes trading so unsuccessful for them. It should be easier than ever to make money trading. I mentioned previously how small today's bid-ask spreads are compared to 20 years ago. Therefore, it should be easier than ever for traders to make money. However, it isn't. People are still struggling to make money trading. My main premise of this book is to get to the bottom of this conundrum. The approach I have taken is centered around the following facts. 1. It has never been easier to trade. The IT infrastructure is superb for traders. 2. The spreads have never been lower. 3. The margins have never been more favorable. 4. The tools have never been so readily available. 5. The brokers have never done as much for their clients as they do now. 6. The stock indices have never been higher, meaning there is volatility. To reiterate, I assume that people who open trading accounts are normal, well-adjusted human beings, without using this as a slight or an insult, who are perfectly capable of functioning within society. The questions I want to ask and answer are these. What does normal behavior look like? How can I avoid being normal when I trade? If we assume that 80 to 90% of people trading are normal people, I want to avoid acting like they do. Are you normal? My argument, provocative as it is, asks an essential question. Are you thinking like everyone else is thinking and approaching trading like everyone else is approaching trading? If so, you will have a problem. If you think like everyone else, is it so strange that you get the results that everyone else gets? Let us take a look at what normal behavior is. Normal behavior is to engage in a never-ending cycle of education, looking for the next new edge. I knew from the moment I read Liar's Poker that I wanted to be a trader, but I never had any formal training in how a good trader behaves. Why should I? I was always told that a good trader buys low and sells high. But every time I bought low, it always went lower and lower. So what kind of advice was that? And yet this is the advice we listen to when we start. This is the benchmark. And if this is the benchmark, then it is a miracle that it is only 90% that are losing. It should be 100%. Because buying low and selling high is a sure recipe for ruin. People will attend weekend courses hoping to learn secrets. People will study and learn to use tools such as candlestick analysis, stochastics, relative strength index, RSI, MACD, and moving averages. The list goes on and on. All of this is normal behavior in a nutshell. Even the Bible is wrong. Even the Bible of technical analysis doesn't do much to help a person on their way once the initial learning curve is over. The Bible of Technical Analysis was authored by Robert D. Edwards and John McGee. The book is called Technical Analysis of Stock Trends, and it has sold millions of copies since its first printing in 1948. What most readers don't realize, however, is that Edwards and McGee were not the real creators of modern technical analysis. Rather, it was a little-known technical analyst named Richard W. Schabacker. A brilliant market technician, Schabacker codified almost everything there was to know about technical analysis up to his time, which included such pioneering work as the Dow theory of Charles Dow. Between 1930 and 1937, Schabacker taught several courses to serious Wall Street traders and investors. Unfortunately, he died in 1938, when he was not even 40 years old. Shortly before his death, Schabacker gave a mimeographed copy of his lessons to his brother-in-law, Robert D. Edwards, who rewrote Schabacker's lessons with the help of his collaborator, John F. McGee, an MIT-trained engineer. As a result, it was not Schabacker who received credit for the original compilation of technical analysis, but Edwards and McGee, whose work became a perennial bestseller. Let me be clear. Reading a book like Technical Analysis of Stock Trends is a must, but please don't think that it will make you a professional, profitable trader any more than reading a manual on tennis will enable you to compete with Rafa Nadal. I see newcomers make classic mistakes after reading books on technical analysis. They will study indicators such as RSI and stochastics, and they will excitedly declare that a market is overbought or oversold. What they don't realize is that overbought is an emotional expression for a psychological conceptualization of expensive. The people reading a stochastics chart are led to believe, through a mathematical manipulation of data, that the market is now expensive and it should be shorted. The same can be said for oversold. It is another way for the mind to tell you that the market is cheap and that there is value associated with it. I'll give you an example. Yesterday was a particularly bearish day in the Dow Jones Index and the German DAX 40 Index. I was short all day and I had one of my better days, all verified and documented on my Telegram channel. It was 1 October 2019. Towards the end of the day, when the Dow Index was falling even lower, a student of mine contacted me and asked me a very alarming question. The conversation was in Danish and I have translated it here. Tom, have you seen the stochastics indicator? It is deeply in oversold territory. Do you think it is a good idea to buy now, ahead of the close? I reply, I am short. Maybe you should ask someone else. He goes on to express his absolute shock that I am short, and a little later he goes on to state that he has bought the Dow at 25,590. Of course, when there is a buyer, there is a seller. However, I am not convinced that buying the Dow Jones Index 10 minutes before the close on a day where it has fallen 400 points is a good idea. It reminds me of the kind of thinking I would have done 20 years ago. Not today, though. If I buy the Dow on a weekday just before the close, it is to close a short position. I value my sleep too much to carry a position overnight. I said to him, "You had all day to find a short entry. What are you hoping to achieve by being a buyer now? Are you thinking that because it has fallen 400 points, now it is cheap, and maybe just before the close you may see some buying of these cheap stocks?" I used to think like that too. That was when I was not profitable. The Dow didn't rally into the close. There was no bounce. I am sure my student didn't lose a lot. It wasn't so much his wallet I was concerned about, it was his way of thinking. That is what this book is about. It is about making you think the right way about the market. That is where the 80 to 90% of losing traders tend to go wrong. Close the school. If trading was a school, it would be closed. No school or university could function if 90% of its students failed their exams. We are all pretty much normal people. We fit in and function well within the fabric of modern society. If every person engaged in trading is a normal human being, and I assume they are, meaning they are well-functioning, intelligent, considerate, hard-working, then why is there a 90% failure rate in our industry? That doesn't make any sense at all. Usually when people work hard at something, they will succeed, or they will see some degree of success. That doesn't appear to be the case with trading. Other professionals do not have a 90% failure rate. If you go to the dentist and you are told there is a 90% chance he will not be able to fix your teeth, you are out of there like a shot. Yet those are the odds that face a private trader. But it doesn't have to be like that. As traders, we tend to engage in a never-ending predictable cycle. We trade well for a while, we are happy, our discipline weakens, we lose money, we strengthen our resolve, and we get more education. We do well for a while, we lose money, we stop, sometimes for a while, sometimes permanently. Sound familiar? The sad part about this cycle is that everybody has good spells in trading. Everybody has periods when they make money. Everybody has their moments. I am sure you have too. So what happens? What happens is that 99% of people do not know how to lose. The emotions they experience when they lose cause them to act in a manner which is not in their own best interest. Emotions are response-driven. Say you hear a funny joke and you laugh out loud. That is an emotion. When you hear the joke the next time, you don't laugh. Your mind has become habituated to the joke. When you fall in love with a beautiful man or woman, you experience strong emotions, and your inner life is in beautiful turmoil. When you see that person, you just want to express your love for him or her and be united with them, gaze into their eyes. As time goes by, your loving turmoil is replaced with a sense of calm. You love being around them, but the feelings of passion are less pronounced than they were in the beginning. You have become habituated to the other person. A free solo climber, climbing intimidating rock surfaces without ropes, is faced with severe consequences if they lose their grip. They acclimatize their minds through years of practice so that their amygdala, the emotional response center of the mind, is not firing on all cylinders when they are climbing. They are calm. An elite soldier is scared to death the first time he is in a combat situation. That is why his first combat situation will be in a simulation, and the next one, and the next one. And little by little, his fear is trained out of him through the use of repetition, breathing awareness, and habituation. For every hour you spend on technical analysis, you must set aside at least 25% of that time for what I call internal analysis. You need to know what your weaknesses are. You need to know what your strengths are. You need to know what you are good at and you need to know what you are not good at. If you don't spend time trying to improve these things, how will you get better? Very few people, if any, will engage in that level of introspection in order to gain the results they want. If making money trading is your goal, and 99% of people lose, and 99% of people think analysis and strategies are the key to trading profits, you can be 100% sure that strategies and analysis are not the key to trading profits. 43 million trades analyzed. There is a piece of research that makes for very interesting reading. It was the brainchild of an analyst called David Rodriguez, and it is brilliant. Rodriguez worked for a major FX broker, and he attempted to find out why there was such a high failure rate amongst its clients trading currencies. The broker had some 25,000 people who traded FX daily. Rodriguez investigated all the trades executed over a 15-month period. The number of trades was truly staggering. The 25,000 people executed close to 43 million trades. From a statistical point of view, that created a statistically significant and immensely interesting sample space to investigate. Specifically, Rodriguez and his colleagues looked at the number of winning trades. I would like to give you an opportunity, now, to think about how many trades were winning trades and how many trades were losing trades. You can represent it as a percentage of the overall 43 million trades. If you feel it has any influence on the answer you want to give, I can tell you that most of the trades were executed in euro-dollar, sterling-dollar, dollar-Swiss, and dollar-yen. However, the vast majority of the trades were executed in euro-dollar, where the spread is very tight. Unfortunately, that doesn't seem to make much of a difference to the outcome. 62% of all the trades by the broker's clients ended in a profit. That is a little more than 6 out of 10 trades. That's a good hit rate. A trader with a hit rate of 6 out of 10 should be able to make money from trading. Of course, it does depend greatly on how much he wins when he wins, and how much he loses when he loses. Therein lies the problem for the 25,000 people. They were very successful in terms of hit rate, yet when you look at how much they made on average per trade, and how much they lost on average per trade, you soon realize that they had a major problem. When they won, they made about 43 pips. When they lost about 78 pips. There's nothing wrong with having a system where you lose more on your losing trades than you win on your winning trades. However, it does require that you have a sufficiently high hit rate in order to absorb the losing trades. A colleague of mine, a professional trader from South Africa who trades at a hedge fund, has a hit rate of about 25%. I tell his story in greater detail later in the book, but let me explain the term hit rate in the context of his hedge fund. When his hedge fund loses on a trade, they lose 1x. When they win as high as 25x. It stands to reason that my friend is immensely profitable, even though he doesn't have a convincing hit rate, at least not from a traditional perspective. What I find particularly interesting is how much bad advice there is in the trading industry. You will often hear traders talk about risk-to-reward ratio, which in itself is fairly innocent, unless the trader takes it literally and applies it on a trade-by-trade basis. When I call out trades in my live Trader Tom Telegram group, I will always announce a stop-loss. Always. However, I often get asked if I have a target in mind. The answer is quite often a little sarcastic. No, my crystal ball is out for repairs. Or if I'm particularly grumpy and tired, I will be rude and say, "Sorry, amigo, but do I look like a fortune teller to you?" Yes, I know, that isn't very polite. I'm sorry. Ignoring my blatant inability to be polite when I am faced with the same question for the 450th time, there is a deeper meaning to me not calling targets on my trades. It has a lot to do with risk versus reward. Risk versus reward. I personally find the whole risk-to-reward concept enormously flawed, but since I am the only one who ever talks about it, I accept that I am probably wrong. Still, hear me out. How on earth do I know what my reward will be? I literally do not know. Even if I pretended to know, say, by using a measured move calculation or a Fibonacci extension, I know myself well enough to know that I will have added to my trade along the way. When it got to my target, I would not close it because that is my philosophy. I would kick myself if I closed a trade at my target and then it went even further. I would rather give away some of my open profits than miss out on potentially even more profits. Now, I am probably making a big fuss out of nothing, but targets are not for me. I want to see what the market will give me. I am prepared to accept that this may mean I will give away some of my open profits. I have lost count of the number of times I have had a 100-point winner in the Dow, which then turned into a 0. A week before writing this, all documented of course, I had one such winner, which turned into a big, fat 0. Some less than happy traders confronted me in my live trading room as to why I had not taken my profits. It is difficult to explain, but it is all to do with pain. It gives me much less pain to kiss a 100-point winner goodbye than it does to take my 100 points, only to see the market moving even more in my favor. It is because of this philosophy that I am at times able to make 400 to 500-point gains, as I did today. It is one or the other. I don't think you can have the best of both worlds. Interview with CNN. In an interview with CNN some years ago, I was asked about the traits of winning traders. In this very candid interview, I highlighted a few points that I felt differentiated the winning traders from the losing traders. It was based upon my experiences from observing millions of trades by retail traders while I was on the brokerage trading floor. Here are the main differences I identified. Number 1. Trying to find the low. When the market is trending lower, whether intraday or over a longer time frame, there seems to be a tendency for retail traders to attempt to find the low of the move. Whether that is out of a desire to buy cheap or because they use ineffective tools, I simply don't know. What I do know is that this trait is immensely damaging to anyone's trading account. Winning traders seem to be much more trusting of the prevailing trend. This attitude adjustment may seem trivial, but it literally makes the difference between the winning trader and the losing trader. Over time, the losing trader will repeat his distrust in the prevailing trend and will take positions against it. He will do so because from an emotional standpoint, it appears as if he is buying a market that is cheap or selling short a market that is expensive. This is emotionally satisfying, like buying toilet paper at a 50% discount from the local supermarket. But the financial markets are not supermarkets. There is no cheap. There is no expensive. There is just the prevailing price. The winning trader, however, is not emotionally attached to an idea of cheap or expensive. He is focused on this moment right now. And in this moment right now, the market is trending, and he trusts this trend and can unemotionally join this trend without internal discomfort. Number 2. Trying to find the high. The opposite also holds true. When the market is trending higher, traders tend to want to find a place to sell short. Although it must be said that people are generally better at jumping on board a market that has already risen than they are at jumping on board with a short position in a market that has already fallen significantly. If the market has moved higher by a significant amount, especially in the very short term, retail traders tend to want to fade the rising prices, i.e., they look to establish short positions. Again, this is probably the result of a distorted view of things being cheap and things being expensive. Number 3. Thinking every small countermove against a trend is the start of a new trend. I have sat on a trading floor through the darkest days of the financial markets. For example, 15 September 2008, when Lehman Brothers was declared bankrupt, the Dow Jones Index fell 4.5%. Throughout that trading day, there were 2 attempts to rally. Both failed. It was tragic to see how many clients tried to buy the low of the day, only to see the Dow move lower and lower. Whenever there was a single green candle on the 5-minute chart that day, we saw the buy order flow into our position monitors on the trading floor. It seemed as if the clients were possessed by the notion that a low was near and that they had to be the one buying it. The low didn't come that day, nor the next day. This is a common trait amongst traders. They think that every single little counter-reaction against the trend is the beginning of a new trend. More fortunes have been lost trying to catch the lows in a falling market than in all wars put together. Okay, this is an unsubstantiated statement made for emphasis, but please don't attempt to catch lows. It seems obvious to me that newcomers and probably also some seasoned traders, profitable or unprofitable, believe that successful trading is all about charts. This belief is a detriment to their accounts because no one ever took the time to tell them otherwise. No one told them, or thought to tell them, or knew enough to tell them that actually focusing all your time on your charts is a mistaken strategy. We'll look at this further in the next chapter. Everyone is a chart expert. I once declared in an article that you can learn the basics of technical analysis over a weekend. I may have exaggerated a little, but only a little. I know without an inkling of doubt that a chart expert does not equate to a trading expert. I have seen so many of my trading friends build impressive libraries of technical indicators and acquire knowledge about both known and obscure technical indicators. But it didn't translate into making more money. When it comes to charts, less can be more. Charts can be as simple or as complicated as you want. There seems to be a tendency amongst traders to make charting more complicated than it really needs to be. I have seen many new traders plaster their charts with so many tools that they can barely see the price chart itself. It surprises many people, especially newcomers, when they see my chart screens. There is not a single indicator on them, not a single one. I might be old-fashioned, but I don't need these extra tools. My job as a trader is to find low-risk trading setups. My approach to trading is not centered around any other tool than price itself. All indicators, more or less, are built from time and price. Therefore, the indicator is a distortion of the reality I am seeing right in front of me. The markets can be range-bound or the markets can trend. Some indicators work well in ranging markets. These usually perform terribly in trending markets. Other indicators work well in trending markets, but are dreadful to use in range-bound markets. As a famous trader friend of mine, Tepid2, once said on the now-defunct trader feed Avid Trader, indicators, they all work some of the time, but none of them work all of the time. I think that many of the 90% of people that lose money trading may very well have excellent chart reading abilities. They can read charts very well, and they understand patterns too. However, I happen to think there is much more to trading than knowing a head and shoulder formation, a bar chart pattern, or a Fibonacci ratio. I have seen outstanding traders juggle millions of pounds worth of stock index futures contracts using nothing but a simple 10-minute chart. In fact, I do that myself every single trading day. I truly believe that what separates the 1% from the 99% is how they think when they are in a trade, how they handle their emotions when they trade. That is not to say that there is no merit to learning the craft of chart reading. I know from my own experience that chart reading is an absolute must for my decision-making. But that is only a small part of the whole trading picture. The proliferation of gurus selling trading courses is evidence there is a demand to learn the art and craft of trading. I suspect the shortcut of a weekend course is a much more appealing proposition than spending that time reading books. If a guru holding a weekend course on trading claims that you will be qualified to trade like the millionaire professionals by the Sunday night, then the unsuspecting will select that option. It is perfectly natural to expect a human being to drift down the path of least resistance. Learning any new skill takes time. So when you see an advert saying, "Learn a new language in 30 days," you might not believe it consciously, but subconsciously you want to believe it, because people love shortcuts. Similarly, a diet book that promises you will lose 5 kilograms in a year is unlikely to sell as well as one promising you will lose 5 kilograms in 2 weeks. My philosophy to life is different from so many other people's. This is the reason I have what so many other people dream of. I will choose the path of most resistance because I know I need to stay clear of the opinion of the 99%. If you think I am conceited, then you are thoroughly mistaken. I have no inflated view of myself. Quite the contrary. I decide carefully what I want, and then I work towards it. This book reflects that ethos. You truly can be a master trader. You truly can live in the house you desire, with the cars you desire in the drive. But you must believe me when I say that in order to get what you want, you need to think like the 1%. In fact, you don't even need to think like the 1%. You just need to not think like the 99%. The following trade is a good example of how mindset trumps technical analysis any day of the week. In this example, I short the German DAX 30 index. I get stopped out for a loss. I kick myself because my stop loss gets exceeded by a point or so, only to reverse back in my favor. My stop was too tight. Rather than lose my composure, I dismiss it. Let me pause for a second. Do you know why some athletes let out a shout of frustration when they are not performing well? I thought about it for a while, after I saw Serena Williams shout when she lost an important point in a Wimbledon tennis final. I think they let out a cry because it is a way to reset the mind, to come back into balance and get into the zone again. The act of letting out a cry helps them get rid of the frustration and find their inner peace and balance again. I re-enter a short position at 14,479.80. The screenshot below is from the time of the trade. Germany 30, sell, amount 200, open price 12,479.8. Current price 12,478.5. Open PL 260 euros. Wall Street 30, sell, amount 200, open price 27,044. Current price 27,046. Open P&L negative $500. The chart at the time of the trade looks as shown in Figure 1. The DAX had gapped up. Did you know that only 48% of all gaps get filled on the same trading day? By the third trading day after the gap, 76% of gaps were filled. Why am I telling you this? Don't believe trading books stating that all gaps get filled. They do not. I short the DAX because the second bar on the chart is an inside bar from the first 10-minute bar at the open. The third bar closes below the lowest point of the inside bar. Now I have a sell signal because the first bar's high is at the same price as a prior high, a double top. I have a stop loss in place. I have done my job as a trader. I have identified a low-risk entry point, and I have placed my stop loss. At this point in time, I am at the mercy of the markets. Maybe this will be a great trade. Maybe it won't. Who knows? No one knows. Before I carry on, I would like to ask you a question. It is a question for you to ponder upon. Say you believe in the whole risk-to-reward argument, and you decide that you have a 40-point profit target. You decide upon a 40-point profit target because you risked 20 points. So, you argue that risk to reward is 2 to 1. 2 units of profit for 1 unit of risk. Which sounds good. It all sounds great, and there is virtually no textbook on trading that would argue against it. But I am arguing against it. I want you to ask some simple questions. If you make 40 points on this short position and the market continues in your favor, how will you feel? How will you feel if a few hours later you see the market down a further 100 points from your exit? I think the risk-to-reward concept has been designed by an academic who does not understand risk and the mind's association with risk. I think this academic has created a method to keep his mind at peace in order to avoid pain. 50 minutes later, the DAX is filling the gap. This is shown in Figure 2. The position is in profit. A colleague of mine has followed my trade. The chart is looking good for us. We are in a conversation about the trade. It goes like this. Friend, I am tempted to take my profit. Do you have a target for this trade? Tom, Amigo, I don't trade with targets. Let's see what the market will give us. Stop loss is at break even. We can't lose. Friend. Yes, I know, but yesterday was a poor day of trading. I lost 150 points. I read the market poorly. I had an idea and the idea didn't work out. Either way, I lost 150 points. If I close my DAX position right now, I can make up for the lost trade this morning, and I can recover a lot of the points lost yesterday. What do you think? Tom. I think you are trading yesterday's experience. You haven't wiped the mind slate clean. You are not present. You are focused on the past. You are trying to get back to an emotional equilibrium. You are in a state of imbalance because you are unable to shake the loss from yesterday. As a result, you are not judging the trade on its own merit, but on the merit of a past trade. You are not seeing the world as it is. You are seeing it as you are. I understand it is a soothing thought to close the trade. However, we are not trading to break even. We are trading to make money. Can you appreciate that trading is a mind game? It is a game of nerves. My friend was understandably shaken from his loss yesterday. He carried the loss over to the next day. It affected his decision-making. Back in 2007, I was invited to the Wimbledon tennis final. My friend was a big name in the media industry, and none other than Ralph Lauren had invited her to the tennis final with a guest. So, there I was in the VIP tent, and I got to sit next to Luke Donald, who at the time was one of the best golfers in the world. He is a softly spoken man and very polite. We got talking about Tiger Woods, and I asked him a pretty to-the-point question about competing with Tiger. Is Tiger Woods a better golfer than you? I found his answer so incredibly insightful that I never forgot it. He said, I don't think Tiger is a better golfer than me, if you measure it in how well we putt or how far we hit the ball. But Tiger Woods does have an amazing ability to forget his mistakes and move on. For example, we can be on the 15th and both make a bad putt. By the time we get to tee up on the 16th, it is as if Tiger has wiped his mind of whatever happened on the 15th, and he is totally in the moment. I, on the other hand, will still deal with the mistake I made on the 15th, and it will affect my performance on the 16th. That is a truly insightful perspective of what really separates the very best in a chosen field. It is the mind, and what it processes at any given moment in time. Is it working with you or against you? Cognitive dissonance. My friend is having a ping-pong dialogue in his head, arguing for and against taking profits. I am no stranger to that conversation. I may have many years of trading experience, but I still have those thoughts in my head. I am just mindful of them when they arrive. When they do, I focus on the chart and what it is telling me. I don't look at the profit and loss, P&L. What my friend is experiencing is known as cognitive dissonance. In the field of psychology, cognitive dissonance is the mental discomfort, psychological stress, experienced by an individual who simultaneously holds two contradictory beliefs or ideas in their head. This discomfort is triggered by a situation in which a person's belief clashes with new evidence contradicting that belief. When confronted with facts that contradict beliefs, ideals, and values, people will try to find a way to resolve the contradiction to reduce their discomfort. The best way for your rational mind to solve the discomfort of a profitable position is to close it. The best way for the rational mind to resolve the discomfort of a losing position is to let it run. In his 1957 book, A Theory of Cognitive Dissonance, author Leon Festinger proposed that human beings strive for internal psychological consistency to function mentally in the real world. He says that a person who experiences internal inconsistency tends to become psychologically uncomfortable and is motivated to reduce the cognitive dissonance. One way to achieve the goal of reducing the discomfort is by making changes to justify the stressful behavior, either by adding new unsubstantiated or irrelevant information to the cognition, or by avoiding circumstances and contradictory information likely to increase the magnitude of the cognitive dissonance. In my friend's case, he is conflicted. He is associating pain with the performance of yesterday. He has an opportunity to eradicate the pain by closing his profitable position right now. The way he justifies this reasoning is by ignoring the information the market is giving him about his position. The market participants agree that the market should be sold short, but instead of acknowledging this, he is ignoring it. From a logical point of view, this all makes sense. From an emotional point of view, this is an inconsistent approach to trading. Our trades from yesterday have no bearing on the markets today. It is a new day. It is a new set of circumstances. Yet to most people's minds, the two trading days are connected. To our minds, we are continuing today what we did yesterday. Why wouldn't we be? We tell ourselves. Are you telling me that you can't reset your emotions every morning? Are you telling me that you can go to bed at night after a blazing row with your loved ones and wake up reset and emotionally in equilibrium? I doubt it, at least not without a conscious effort. It is for this reason that I warm up ahead of the trading day by going through a process. We cover that later in the book. It is, after all, what the book is about. It is a recipe book for methods to avoid the pitfalls that the 90% experience. Now, what is the source of my friend's turmoil? It is fear. Pure and simple. He is afraid he will lose what he has made on paper. He is desperate to get back to an emotional state where he is at peace. He is no longer trading the charts. He is no longer trading the markets. He is trading his own mental well-being. Fear. My friend is fearful. He is afraid that the money he lost yesterday will not be offset by the good trade he has going now. He is afraid that the profits he is currently experiencing will diminish, or in the worst case, disappear. He acknowledges that he can't lose on the trade. The stop loss is now at break-even. Unfortunately, that gives him little comfort. I once saw a quote that made me smile. Everything you ever wanted lives on the other side of fear. Yet fear is a necessity in our lives. The human brain is a product of millions of years of evolution, and we are hardwired with instincts that helped our ancestors to survive. We need fear to ensure survival in certain situations, but many of the fears that we carry are not appropriate for our trading. Our minds have a primary function, which is to protect us against pain. If you introduce big drastic changes in your life, you are likely going to come face to face with that pain. A clever way to build staying power during change is to introduce that change slowly. Say you set yourself the ambitious target of running a marathon. You achieve this goal by building up your body and mind for the task. Trading big size is exactly the same process. You need to give your mind time to learn to handle the mental anguish that comes from losing when the stakes are bigger. There is no point in comparing yourself with others. Sure, take inspiration from others, but know this is a personal journey, and your job is to achieve an equilibrium mindset, no matter what size you are trading. Philippe Petit. I saw a documentary about Philippe Petit a long time ago. Petit was a French artist who strapped a wire between the two World Trade Center buildings and then walked across it, several times. What struck me about the incredible feat was the preparation. It took Philippe some 7 years of physical and mental training to accomplish the feat. Did you think he just set off and hoped for the best? No. In fact, his original training height was quite modest compared to the altitudes he would eventually reach. Philippe Petit is a fascinating character. He is someone who has had to deal with fear at a level beyond that which the rest of us have. I have learned a lot about fear and identifying my own shortcomings by studying his approach to his craft. Visualization. Before my high-wire walk across the Seine to the second story of the Eiffel Tower, the 700-yard-long inclined cable looked so steep, the shadow of fear so real, I worried. Had there been an error in rigging calculations? How does Petit overcome these doubts? With a simple visualization exercise. On the spot, I vanquished my anxiety by imagining the best outcome, my victorious last step above a cheering crowd of 250,000. Added to this, Pettit exaggerates his fears. Rather than try to muscle through or outwit fear, he suggests taming it by building it up, so that when you are finally faced with your fear, you will be disappointed by how mundane the threat really is. A clever tool in the arsenal to destroy fear. If a nightmare taps you on the shoulder, do not turn around immediately expecting to be scared. Pause and expect more. Exaggerate. Be ready to be very afraid, to scream in terror. The more delirious your expectation, the safer you will be when you see that reality is much less horrifying than what you had envisioned. Now turn around. See? It was not that bad. And you're already smiling. He goes on to say that he has fears like everyone else. In particular, he talks about his dislike of spiders. On the ground, I profess to know no fear, but I lie. I will confess with self-mockery to arachnophobia and cynophobia, a fear of dogs, because I see fear as an absence of knowledge. It would be simple for me to conquer such silly terrors. I am too busy these days, I'll say. But when I decide it's time to get rid of my aversion to animals with too many legs, or not enough legs, snakes are not my friends either, I know exactly how to proceed. I will read science reports, watch documentaries, visit the zoo. I will interview spider wranglers. Is there such a profession? To discover how these creatures evolved, how they hunt, mate, sleep, and most importantly, what frightens the hairy, scary beast. Then, like James Bond, I won't have any problem having a tarantula dance on my forearm. Pettit's walk remains one of the most fabled and stunning acts of public art ever. He says there was no why behind the act. To quote his own words, "To me, it is really simple. Life should be lived on the edge of life. You have to exercise rebellion, to refuse to tape yourself to rules, to refuse your own success, to refuse to repeat yourself, to see every day, every year, every idea as a true challenge, and then you are going to live your life on a tightrope." The ego and wonderful failure. I am not a fan of cliches. They display a lack of original thought. I am quite cynical towards those who peddle cliches. It doesn't sit well with me to hear people say that I should run my profits and cut my losses. Yes, but how do I deal with the fear of running my profits? It doesn't sit well with me when a female friend tells me she is in an abusive relationship, and another friend chirps in and dismissively states that the solution is to just leave the bastard. It is a platitude. It is factually true, but is nonsense nevertheless. When a solution is obvious, the problem is rarely the only problem. You might as well tell an alcoholic to just stop drinking. There is a reason he is drinking, and there is a reason he is struggling to stop. Does failure exist? I come from a home where you rarely received praise for your achievements. They were expected. The failures, on the other hand, were pointed out, and not in a constructive manner. I had to retrain my mind to stop being afraid of making mistakes. I used to have a favorite saying as a child, "It's not my fault." Today the buck stops with me every time. It is always my fault. I am good at making mistakes so that I can learn from them. Failure is a friend in life, if you tell your mind that it is okay to fail. I participate in a radio program about trading and investments. The focal point of the show is the competition between two other traders and me. The competition is always fierce, and every week we are questioned about the content of our portfolios. My trading style is quite black and white. If I think the market is headed lower, I will buy some put options or some bear certificates, and vice versa if I am bullish. I learned a long time ago that the best way to shut down a journalist is to be 100% honest. So when the radio host baits me by saying, Tom, you got that one wrong, huh?" The worst thing I can do is to start defending myself. If I start making excuses or argue a defensive stance, I simply pour petrol on that fire. It is such a great metaphor for life. Own up to your errors and be done with it. So when the radio host is trying to engage in a line of questioning aimed at getting me to defend myself, I always double down in the opposite direction by saying something like, "Oh my lord, I don't think I could have ever been more wrong even if I tried." Or, "Oh boy, even a 5-year-old could have done better than me." trading mind upside down. From my research into the behavior of our clients during my years at City Index, I concluded that the overwhelming majority had an unhealthy mental thought pattern. They would feel fear at times where there was no reason to be fearful. This would manifest during times in which their positions were making money. However I manipulate the argument, it is still a fear of losing. In this case, it is a fear of losing the profits accrued on paper. When the clients were in losing positions, they would be reluctant to realize the loss. It was as if they had the attitude that as long as the position was open, it might still come good. As I see it, they opted to replace fear with hope. They hoped the losing position would come back to break even. Going back to the DAX example, my friend hung on to the trade. I did my best to guide him through the pain. He moved his stop loss down. It meant he had some profits to show for it if the market moved back up again. In my experience, if you can guide a person through a successful trade where he or she holds on to the trade, you will begin to create the right kind of neuro associations. The trader will experience the thrill of holding on to a trade. They will experience the joy of locking in more and more profits. My friend was over the moon with the development of the chart. However, it was quite clear that he was constantly looking for reasons to take profit. The thought of leaving money on the table did not sit well with him at all. To his credit, he held on to the trade, spurred on by my conviction that the market showed nothing but weakness. We were soon rewarded by a sudden liquidity vacuum. I try not to get excited when the market is giving me a windfall. However, at times, even I will have to fist pump the air, even though I am alone in my office. The whole trade sequence is displayed in the time-stamped records in my Telegram channel under 1 October 2019. See Figure 3. Elon Musk. I am not a fan of Tesla. This is due to the fact I shorted it and lost big. Yes, I know. What a silly argument, considering Teslas are seemingly good cars. I am a fan of Elon Musk, however. We are bound to make mistakes in life, but mistakes are like fuel for the rocket of improvement. Talking of rockets, how do you think people like Elon Musk handle failure? He is trying to accomplish incredible, life-changing things like the electrification of automobiles and the colonization of space, and he does it while the whole world is watching. For him, the possibility of failure is ever present. Not only that, but when he fails, it becomes spectacular headline news. Yet Musk just keeps on going and going, doing things that are extremely risky, but also extremely important. How does he handle his fear of failure? Does he even fear failure at all? Or is he somehow hardwired with resilience against this form of anxiety? Apparently not. Musk has publicly stated he feels fear quite strongly. So how does he keep going despite this terror? There are two main elements to Musk's ability to overcome his fears. The first is an overwhelming passion for his projects. He admits that SpaceX was an insane venture, but he had a compelling reason for pushing ahead. I had concluded that if something didn't happen to improve rocket technology, we'd be stuck on Earth forever. People sometimes think technology just automatically gets better every year, but it actually doesn't. It only gets better if smart people work like crazy to make it better. By itself, technology, if people don't work at it, actually will decline. Look at, say, ancient Egypt, where they were able to build these incredible pyramids, and then they basically forgot how to build pyramids. There are many such examples in history. Entropy is not on your side. Elon Musk was not prepared to sit idly by and watch history repeat itself. The second element is what Musk calls fatalism. Just focusing on why you're taking a scary risk isn't always enough to overcome hesitation. It wasn't for Musk. Something that can be helpful is fatalism to some degree. If you just accept the probabilities, then that diminishes fear. When starting SpaceX, I thought the odds of success were less than 10%, and I just accepted that actually, probably I would just lose everything, but that maybe we would make some progress. He is not the only one to use this approach. Visualizing the worst-case scenario can make us appreciate objectively what we are trying to achieve. Facing our fears removes their power over us. Have I digressed too far from the trading journey ahead? I don't think so. I draw inspiration from many sources, both in and outside of the trading world. Kobe Bryant, Rafa Nadal, Cristiano Ronaldo, Sergio Ramos, and Charlie Munger, to name a few. Very different people, yet all obsessed with the journey, the enrichment of their lives, and the perfection of their craft. Studying their approach to their work suggests they found the thing they would love to do even if they didn't get paid for it. I am sure they are businessmen too, and I am sure they keep an eye on the dollars coming in. However, it feels like they perform their craft for the love of it. Do you want it bad? How bad do you want it? Is this journey for you? I don't know. Only you can answer that. Permit me to ask you a question. What is the alternative? You are reading these pages because you want to trade well. Perhaps you have been in my live trading room, and you have seen what my trading philosophy is doing for me. You want to learn more. I applaud that. Perhaps it is time to acknowledge trading for what it is. It's a great way to expose all your flaws. It is a great way to highlight your strengths. Through my trading and my research, I have uncovered weaknesses in my character. For me, the side benefit of earning a living from trading the financial markets is the character traits it instills in me. I am more patient than ever. I am much more focused and disciplined than I was before. Failure is one of our greatest learning tools. Times of doubt. Do you really want to trade profitably? I have had to answer that a few times in my career. I've had to make some sacrifices along the way. I have been called out once by a coach who felt my effort was insincere. I recently found myself having dinner with a friend. I have known him for 15 years. I met him when I gave a speech somewhere in the north of England. My friend had asked if he could consult with me while I was in Manchester to give a talk about trading, and naturally I agreed. As we ate, he became very animated. At one point, he knocked over a glass of water while expressing his frustration with his trading. It was difficult to really pinpoint what the problem was in his trading because he never made any specific reference to a problem. It was clear to me that he really was in distress and wanted help, but I was unable to figure out in what capacity my help should come. So, I offered him help in the one area I felt was appropriate. I offered to go over his trading statements. As I see it, that is the only way I can really help someone. It is a lot of work, but at least I am getting a sense of who he is as a trader. As we said our goodbyes, he told me he would send over his statements. I confirmed and said I would look forward to hearing from him. As I write this, he has not emailed me. He has not written to me on message apps. Silence. Not a word. If I am offered help in an area where I desperately want to excel, and the help comes from a friend who is an expert in the area, I will respond as soon as I can, if not immediately. As of some 4 to 5 days later, I haven't heard a peep. How badly do you think he wants this? How desperate do you think he is? I question how much he really wants this. I have observed this pattern on several occasions. The student claims to be really keen, but in reality it is mere words. It reminds me of a conversation that the famous trader Ed Seykota had with another brilliant trader and friend. The friend told Ed that he intended to coach a losing trader into a winning trader by teaching him some important pointers that were missing from his trading. Ed Seykota paused for a second and then said that the friend would fail to teach the student anything. He said that a losing trader is not going to wish to transform himself. That is the sort of thing that only winning traders do. We can all ask for guidance from someone who is better than us. As the saying goes, you only get better by playing a better opponent. I have guided many that were already well on their way to trading with confidence. I merely refined and suggested. Whether I will hear from my friend or not remains unknown. What is known is that many people open trading accounts in the hope of making money. Their effort is disproportional to their expectations, and their results are aligned with their effort. They simply don't work hard enough. Before I move on to the next topic, I want to warn you. I am a trader who uses charts, but that doesn't mean that I believe charts are responsible for my profitable trading. I once read that technical analysts are afraid of heights. That is another way of saying that they are unable to let their winners run because they keep seeing overhead resistance. I have called the next chapter The Curse of Patterns because I believe fully that as much as patterns help us, they also make our trading lives difficult. In the search for patterns, we see things that are simply not there. The Curse of Patterns. If you strip away the time and price access of a chart, you will likely be unable to differentiate between a 5-minute chart and an hourly chart. In a sense, that is good news. It means we can perfect our craft and then find a time frame that suits our trading temper. The trader with the ability to focus for long stretches of time will find the 1-minute chart and the 5-minute chart provide an ample opportunity to make money. The trader with time constraints will probably favor a longer time frame, such as the hourly chart or the 4-hour chart. It means he or she doesn't have to check the chart so frequently. Charts are far superior to fundamental analysis when it comes to entry points and exit points, and I can use the same tools irrespective of what time frame I'm trading on. Am I opposed to fundamental macro analysis? I would be a fool if I dismissed the fundamentals. The two should not be in opposing camps. They should walk hand in hand as they complement each other and make up for each other's flaws. Now, I would not go so far as to say that chart analysis is the holy grail. Yes, I have made a lot of money from trading charts, but it was not my ability to read a chart that made me a wealthy trader. I don't believe that there is a holy grail when it comes to trading, and I certainly don't believe that chart analysis is the holy grail. Patternicity. Apophenia is a Latin word that translated into English means patternicity. This is a behavior centered around seeing things that aren't there. The tendency to perceive meaningful patterns and connections amongst unrelated events. Patternicity is often a harmless diversion. However, it can be used to support a belief that is otherwise lacking in evidence, like a conspiracy theory. Our minds tend to seek out the information that confirms the bias that we have already decided upon. Therefore, to be completely objective in a chart analysis is virtually impossible. My early mentor, Bryce Gilmore, once commented on this fact. He said to me, "Tom, you only see in the markets and on charts what you have trained your eyes to see." Another perspective of such wisdom was expressed by Anais Nin. She said, "We don't see things as they are. We see them as we are." What is this relevance to trading, I hear you say? I had a friend a long time ago who made a lot of money trading. Nick was a great trader, right up until 2004. He started reading and believing some writers and contributors on Zero Hedge, and he turned bearish on the stock market. He kept shorting, but the market kept going up. He just could not accept that there was no more downside after the bear market of 2000 to 2003. He didn't see the market as it was. He saw it as he was. He was negative. He had read that the bear market would continue. He stopped trading what he saw, and he let his opinion cloud his objectivity. Nick no longer trades. I didn't want to write a book on charts. There are so many books on technical analysis written by people who I doubt trade full-time. I think they tell themselves that because they have a trading account, and because they trade from time to time, they are qualified to write books on trading. Although I trade full-time, I really don't think I could add anything new to the world of charting. Charting didn't make me money. Indicators never made me money. Ratios and bands never filled my bank account. As I am about to post some charts, I want to point out to you that it is to prove a point rather than to educate you on the merits of technical analysis. The trend line fanatical. In the early stages of our chart journey, we come across trend lines. Trend lines are easy to use, and they give the appearance of a great trading strategy, especially when we do it after the fact. Figure 4 shows a naked chart. The diligent chartist begins to draw trend lines. He or she has the full overview of the day. Remember, the brain will have as its prime objective, I repeat, Prime objective: to avoid you experiencing pain. A losing trade equals pain. So the brain sends a signal to the eyes to ignore the setups that do not work. This selection bias creates a distorted image of the validity of trend lines. You can replace trend lines with any other analytical tool from your charting package, and the bias will remain in place. Fibonacci, Bollinger Bands, Keltner channels, etc. Your eyes will see only what they want to see. At best, they may see the losing trades, but they glance over them, diminishing their significance. The result is predictable. The researcher will end up with a chart that looks like the one in Figure 5. It has a lot of trend line setups that all result in great trades. There are no losing trades. Every single trade results in meaningful profits. Such is the power of our subconscious. Cynical traders, people like me, will notice things other traders miss. Not because others don't have the ability to see them, but because they don't want to. See Figure 6. If you are in a research position and you draw enough of these trend lines after the fact, you're most likely going to conclude that trend lines are nothing short of a fantastic tool, perhaps the Holy Grail. There is nothing wrong with trend lines, but they will not make you rich. What will make you rich is how you think when you trade. If you think like everyone else, then your results will be like everyone else's. Don't you want to make money? Don't you want to separate yourself from the herd? Then realize that trading profitably has nothing to do with the instrument you use. In order to prove to you how pointless it is to research tools, I would like to introduce you to two of the world's most esteemed traders, Larry Pesavento and Larry Williams. Larry Pesavento versus Larry Williams. The two Larrys are both in their senior years. They are both Americans, and incidentally they are friends. Both of them have enjoyed trading careers spanning decades. Both of them have made their living from trading. Larry Pesavento is famous for his use of patterns and Fibonacci ratios. Larry Williams is famous for his pattern recognition setups. Both have written several books on their chosen tools. In a workshop I organized back in 2005, Larry Williams, who was one of the speakers, showed statistics from the S&P 500 index, which depicted all the major retracements on an hourly chart spanning a decade. As you can imagine, there was virtually every single conceivable percentage retracement on display. What did not stand out, though, was 61.8% or 38.2%, the two prominent Fibonacci ratios. Sure, they were there, but they were surrounded by masses of other percentages. Yes, it turns out the magical growth sequence of Fibonacci does not, after all, rule the market. So how come it works for Larry Pesavento? The answer is simple. It doesn't have to work all the time to make it a profitable strategy. In Oslo, Norway, in 2016, I gave a talk on Fibonacci ratios. For the talk, I had researched all occurrences in which the German DAX index retraced 78.6%, the square root of 0.618, and I proved that although the 78.6% retracement had a hit rate of 20%, it could still be a useful strategy. You had to risk very little and go for big payouts for it to work. S&P 500 and Fibonacci. The S&P 500 enjoyed an 11% rally during the summer months of 2021. The index rallied from 4,050 to 4,550. Along the way, as you can see on the next chart, there were three significant retracements. The role of the Fibonacci sequence is to enable us to buy into retracements at favorable retracement ratios, such as 38.2% retracement, 61.8% retracement, or even 78.6% retracement. See Figure 7. What I am going to show you now is a simple demonstration of the power of hype and selection bias. See Figure 8. Fibonacci ratios are one of the best-known tools in the trading arena. There is not a single one of these three major retracements in the S&P 500 index that is identified by either 38.2%, 61.8%, or even 78.6% ratios. In fact, two ratios seem to come up more frequently: 43% retracement and 74% retracement. I put that down to randomness. Yes, such is the power of our belief system. We want to believe there is a magical growth sequence to the way the financial markets expand and contract. We want to believe that there is a universal order to the markets, dictated by a higher deity who created the universe using the mathematical sequence of what we know as Fibonacci. And it works just often enough to keep the believers believing. This is the danger of charts. When we research, we are looking for something to get us in on the long side, so we never miss a rally. Or we look for something to make us sell short, so we never miss a short sell. We enter with a bias. This is apophenia in play. Beware. Divorce rates in Spain. The definition of ignorance is a lack of knowledge or information. You can be a smart individual, but be ignorant in some areas. For example, I am rather ignorant when it comes to, say, soulmates and flat earth theory. You could argue that I am ignorant because I am not interested, or I don't believe in it. Fair point. Specifically, on the point of finding your soulmate, the one and only whom you will spend eternity with, the person who is perfect for you in every shape or form, well, I don't believe they are real. You see, as ignorant as I am in the ways of love, I can read statistics, and on that basis, I am supposed to conclude that soulmates have better chances of finding each other in certain countries? I don't think so. For example, there are certainly not many self-confessed soulmates in Spain or Luxembourg. Did you know that there is a 65% divorce rate in Spain and an 87% divorce rate in Luxembourg? There's only a 42% divorce rate in the UK. Does that mean that you have a higher chance of finding your soulmate if you live on the British Isles than in Spain? Plenty of people believe that the sun's heavenly position relative to randomly defined stellar constellations at the time of my birth somehow affects my personality. There are also people who believe that the markets are an equation to be solved, a code to be cracked. All of those people are delusional, or to put it more politely, they are ignorant. The fraud of the candlestick guru. In order to avoid a lawsuit, I have blanked out the name of the central character in the following story. When candlestick charts became a hot topic in the 1990s, one person, who had been instrumental in the propagation of their use, was sitting in a restaurant somewhere in the world with another high-profile trader and me. The central character had at the time published books on the use of candlestick charts. As we sat in the restaurant, I asked him if he believed that some of these patterns had to be identified by different names when they were practically identical. For example, I argued the harami pattern and the harami cross pattern are to all intents and purposes identical, except the harami cross pattern has no body, while the harami pattern has one. However, they are both inside bar patterns. It seemed to me like a deliberate attempt to inflate the number of patterns for purely commercial reasons rather than for legitimate trading reasons. Many of the patterns are near identical, but have different names. I asked him if he had a favorite pattern he used or a selection of preferred patterns he stuck to, and if so, what time frame he traded them on. He answered that he wasn't trading the patterns. Not only that, but he also conceded that he didn't trade at all. I don't know how you feel about that, but it doesn't sit very well with me. I immediately cut all ties with the gentleman. I felt as if his only mission was to invent as many patterns as he possibly could, in order to fill pages in books and courses and create alerts on his trading software. Am I arguing that candlestick charts are worthless? No. I just don't believe that there is statistical relevance to all the patterns. I am not alone. A handful of academic research articles suggest the same. Here is the conclusion from one such article, a statistical analysis of the predictive power of Japanese candlesticks, written by Mohammed Jamaluddin, Adrian Hines, and Lissa Palaccia, and published in the Journal of International and Interdisciplinary Business Research in June 2018. Japanese candlesticks is a technique for plotting past price action of a specific underlying, such as a stock, index, or commodity, using open, high, low, and close prices. These candlesticks create patterns believed to forecast future price movement. Although the candle's popularity has increased rapidly over the last decade, there is still little statistical evidence about their effectiveness over a large number of occurrences. In this work, we analyze the predictive power of the shooting star and hammer patterns using over 6 decades of historical data of the S&P 500 index. In our studies, we found out that historically these patterns have offered little forecasting reliability when using closing prices. In another work, by Piapis Daravanij, Vasan Siraprapasari, and Kirichai Rajchamaha, the researchers conclude the following. This article investigates the profitability of candlestick patterns. The holding periods are 1, 3, 5, and 10 days. This study tests the predictive power of bullish and bearish candlestick reversal patterns, both without technical filtering and with technical filtering. Stochastics, percentage D, relative strength index, RSI, money flow index, MFI, by applying the skewness adjusted t-test and the binomial test. The statistical analysis finds little use of both bullish and bearish candlestick reversal patterns, since the mean returns of most patterns are not statistically different from zero. Even the ones with statistically significant returns do have high risks in terms of standard deviations. The binomial test results also indicate that candlestick patterns cannot reliably predict market directions. In addition, this article finds that filtering by percentage D, RSI, or MFI generally does not increase profitability nor prediction accuracy of candlestick patterns. Traders beware. Brokers and educators have put the cart before the horse. They make us think that learning as many patterns as we possibly can will increase our chances of trading success. This is simply not true. The more patterns we know, the more we are inclined to talk ourselves out of good positions. There is nothing wrong with technical analysis and patterns, and candle formation and indicators, and ratios and bands. Yes, I don't believe in many of them, because they are subjective and don't hold up under real scrutiny. But then again, trading is so subjective anyway that we don't need to be right very much to make a good living from trading. An Old Fox Tells. My friend Trevor Neal ran a hedge fund that had a 25% hit rate on their trades. I want to tell you his story here to give you some deeper insight into how some of the best professional traders work and think. I hope you will find it illuminating. It should also serve as a reminder that there are many ways to make money in the market. Your job is not to follow someone, but to find a way that you like, that resonates with you, and who you are, and what you like to do. The story starts with me asking Trevor a question. I knew that he had been associated with Tom DeMark and his sequential indicator. Tom DeMark is something of a legend within the technical analysis world. I happened to have met DeMark myself at a Bloomberg lunch many years ago. He seemed like a nice guy, although I had very little to ask him, as I was unfamiliar with his work. You see, his work was only available to those who had a Bloomberg terminal. The Bloomberg terminal at that time was some $25,000 a year. Today, though, Tom DeMark's work is available on many trading platforms, in case you're interested. I asked Trevor about the sequential indicator, and his eyes lit up. He told me a story about how he and his friend had decided that there was an edge to be gained from trading the sequential indicator on a very short-term time frame. They moved to South Africa and started trading South African shares on a 1-minute chart. I have never heard of a professional outfit with significant funds under management trade on such a short time frame. However, that is not what impressed me most about the story. What impressed me most was how they managed to make money on what other traders would consider an abysmal hit rate. Most people believe that you have to deploy a trading strategy that has a hit rate better than 50%. Trevor told me that their results varied. There were times when they were hot, and there were times when they were not. When they were hot, the hit rate would push 40%. When they were not, the hit rate was down in the mid-20s. Overall, though, they had in their hands a tool that generated about 25 to 30 winning trades out of every 100 trades placed. They were wildly successful. They traded the fund for a handful of years, then they returned the capital to the investors. They had made their money, and as neither of them were spring chickens, they decided enough was enough. It was time to go home and spend quality time with their families. Had they been younger, they probably would have continued. Now, I don't know about you, but I like the story. It reaffirms the idea that I have about trading. How you think when you trade is much more important than whether your strategy has a hit rate in the 50s, or in the 70s, or in the 90s. While the story is not conclusive evidence that anyone can make money trading, as long as they have the proper money management rules and the required patience, it is a brilliant anecdote of two traders being able to make money even though, from a conventional point of view, their strategy on paper should not have generated a profit. So, what was the secret? Well, the answer is simple. Although they lost 75 out of 100 trades, those 25 winning trades more than surpassed in profits what the 75 trades generated in losses. Trevor told me that they expected to make 25 times in profit what the risk was. He also told me that when they executed a trade, they expected it to work immediately. So I grilled him a little bit on that point. "What do you mean you expected it to work immediately?" I said. He said he meant exactly that. When they executed a trade, they expected the trade to begin to work immediately. If they had bought at 50, they would not want it to go to 48. If it went to 48, they would stop themselves out. It meant they had plenty of small losses. Their backtesting had shown that if the strategy was to be traded correctly, it would work immediately. If it didn't work immediately, the strategy called for the position to be closed. Believe and act. When you can act and perform without any fear of consequences and repercussions, you are trading from an ideal state. When you consider how many people lose money overall in trading, you logically have to conclude that achieving this state is not an easy undertaking. It would be foolish to think that this state of mind comes easily or even naturally. It doesn't. I once sat and traded for a few months with a guy from Germany. He possessed an almost superhuman ability to do nothing. His patience was unrivaled. While we traded together, I made it a sport to be as patient as he was. It was fun and, dare I say, somewhat painful. I missed many a good trade, but the ones I took outweighed all the others. You must be patient with yourself. You must be able to let your knowledge settle and mature within you. If you trade small size now, but you want to trade bigger size in the future, then that journey will most likely be anything but linear. It will be a journey of progress and setbacks. It will be a journey of progress and status quo. I can guarantee you that you have to grow into the trader you dream of becoming. You must be patient with your trade entries. You must be patient with yourself. If you can bring those two qualities to the table, then the rest will solve itself in time. You will grow your trade size at a pace where your mind will not be alarmed or fearful. I discuss this in much greater detail towards the end of the book. Otherwise, I am just like the well-meaning friend who says to my alcoholic friend, "Well, just stop drinking." Sure, if only it were that easy. Likewise, me saying to you, "Just have more patience," is about as helpful as a hog roast at a vegan convention. One macro trader I deeply admire is Greg Coffey, an outstanding London hedge fund trader. In a piece in a newspaper, one client described him as humble and arrogant in equal measures, the perfect trader. The piece went on to describe that Coffey had an absolute conviction on his trades, to the point of being arrogant, but he was equally quick to be humble when the trades didn't work out well. Remember this saying: "It is not what you know that kills you. It is what you think you know, but which just isn't so, that kills you." The nature of the game. The game never changes, and it never will. Algorithms won't change the game. Laws won't change the game. Because this is an inner game, and you need to spend time, Maybe not as much time as you do on charts, but a huge amount of time contemplating what human qualities you are bringing to the game of trading. Moving in the right direction comes from knowledge of yourself and an understanding of the markets. The game never changes. The players change, of course. We all grow old and die, and we are replaced with fresh blood. Sadly, people don't change, unless they make an out-of-the-ordinary effort to do so. We have a reptile mind, which is not fond of change. Hey, if it ain't broke, why do you want to fix it? Well, because it is broken. I am not making money how I know I can, so I want to change that. If that means I have to learn to live under a different paradigm and have a different perspective on fear and hope, so be it. The role of charts. You can't create a master painting with just one color. You don't create a Michelin star meal with just one ingredient. And you most certainly do not create a viable business as a trader by only focusing on charts. The role of the chart is to give you a visual representation of the thoughts of other market participants. It enables me to be much more specific in my entry and exit criteria than, say, a fundamental trader. However, it is easy to get seduced by the randomness of charts. Over time, though, it is not your chart reading skills that will decide the number of zeros on your trading account. Controlling your mind is no easy task. Your reflex mind will jump to conclusions before your conscious, reflective mind has had a moment to really consider your response. The sole purpose of this book is to provide you with the right tools to program your mind to be a trader, a profitable one. Our minds are feeble creatures, if left unchecked. Whenever I give a talk about the role of psychology in trading, I always show people the logo of Federal Express, and then I ask them, where is the arrow? In case you didn't know already, take a look at the FedEx logo. There is an arrow hidden between the E and the X. The coordination between the eyes and the mind is fascinating. The eyes can see one thing, while the reactive impulse mind tells us that we are seeing something else. It is only through observance and training that we become mindful of our tendency to believe what we immediately think we see. Consider the following image. Which square on this checkerboard is darker, A or B? You might be surprised to learn that both squares are exactly the same shade of gray, though it is very likely that your mind told you that square A is darker. Published by MIT professor H. Adelson in 1995, this optical illusion perfectly demonstrates how the mind can misinterpret information passed to it by the eyes. Another example that you may have encountered before is a little harder to demonstrate in this book, but I will explain how it played out in the speech I gave, which gave me the impetus to write this book. It is a mind flexibility exercise. I showed the audience a simple image, a red square. I asked them to call out the color of the image. Red, they shouted in unison. Simple enough, right? I then removed the red square and revealed a yellow one. Same result. Yellow. I swapped in a green square. Green, they cried. Red, yellow, green. So far, so good. The audience didn't even need to think about it. That is how dominant the automatic response system is. Then we moved on to the trickier bit. I showed the audience an image of the word red written in blue ink and asked what color the image was. A lot of them called out red. I showed them yellow written in red ink. Some called out red, but I heard far more shouts of yellow. We repeated this process with a series of color names written in ink of a different color. Over time, the audience responses became more consistently accurate. Through a humorous exercise, I established that our eyes and minds do not necessarily work in a coordinated manner. Our brain, seeing the word red, wants us to say red, even when the answer to the question is blue. It is as if we consciously need to stop the brain from jumping to conclusions. This is an important trait in trading, because we often see things that are literally not there. Charts do not work as well in real time as after the fact. Unfortunately, you have to believe and act. If you struggle with that after a few failed trades, then that is your brain trying to protect you against pain. You will begin to second-guess your signals, and you will sabotage your own best interests. I have been there. I have done it. And I have the cure. Good trading goes against human nature. When I make speeches about trading, in person or on YouTube, I often talk about the concepts of value and price. What is something worth? I think my old car is worth £10,000. The car dealer feels it is worth £8,000. Who do you think is going to win that argument if I am keen to sell? What something is worth is an emotional, biased statement. Price, on the other hand, is where buyers and sellers meet. It doesn't make much sense to say that something is worth more. You can anticipate that something will be worth more or less in the future. I mean, that is the essence of the mechanics of my job. Psychology aside, I buy in the hope that whatever I buy will rise in price. Heraclitus, the pre-Socratic Greek philosopher, said, "No man ever steps in the same river twice, for it's not the same river, and he's not the same man." That is important to bear in mind as a speculator, because the market changes constantly. Mankind has an ambivalent attitude to change. We want to change, because otherwise our lives become mundane and boring. But if the change is thrust upon us rather than driven by motivation and enthusiasm, then we tend to resent it. The first time I became aware of the importance of mindset in trading was upon reading a book about the trading life of an anonymous trader called Phantom of the Pit. It is a free book. You can find it with my own notes on www.tradertom.com in the resource section. In the book, the mystery trader argues that behavior modification is the single most important concept in trading. The ability to change one's mind without causing a mental disequilibrium is the single most important ability for a trader. Running a live Telegram trading channel means I am constantly asked questions, the majority of them from inexperienced traders. One persistent question I get is, "Why are you trading against the trend?" When I get asked such a question, I smile, because it is both a naive and innocent question. It is naive because any trader can be accused of trading against the trend. It simply depends on the time frame you are looking at. If you are a 5-minute candle trader, you don't care that the trend on the weekly chart is down. You care about the trend of the 5-minute chart. Another reason why it is naive is because the whole construct of technical analysis is fraught with contradictions. Think about it. You are asked to follow the trend. But what happens when you sell a double top? You are betting against the trend. The same can be argued for a double bottom. You are buying a market that is moving down. 30 years of data. I am a day trader. My specialty is stock indices such as the Dow Jones Index. I looked at the statistics of closing prices in the index over the last 30 years. That equates to roughly 7,500 trading days. I wanted to know how often the Dow Index closed higher for the day and how often it closed lower for the day compared to the previous day's closing price. I had an idea that, since the Dow Index over the last 30 years had risen from 3,300 to nearly 36,000, you could expect more positive closing prices than negative closing prices. I was wrong in that assumption. Over the last 30 years, only 50.4% of all closing prices were higher than the previous day's closing price. This means the distribution of plus days and minus days in the Dow Index is evenly distributed. The ramifications of this statistic is that day traders like me can't rely too much on the trend on the higher time frame, because virtually anything can happen down on the 5-minute chart. The challenge traders face can be summed up very easily in a Heraclitus-style explanation. When we shop for a pint of milk, we know that milk is a uniform product. It doesn't matter where on God's green earth you shop for a pint of milk. Milk is milk. Hence, if milk costs twice as much in one supermarket as opposed to another supermarket, you can again rightly conclude that a pint of milk is expensive in one supermarket and it is cheap in the other supermarket. However, a share or a currency or a share index is like a river. It is in constant transformation. The transformation is the result of the interaction of traders and investors. Their action is the result of their opinions about the future. You may agree with their opinions, or you may disagree. But to say that the majority are wrong is counterproductive to efficient money-making in the markets. There are many part-time traders who are incredibly successful in their other careers, but struggle when it comes to trading. What we have to do to succeed in the world of trading is significantly different to what we have to do to succeed in the world outside of it. For example, if you go into a supermarket to buy dinner and you see that there is a special offer on chicken, you will be inclined to take advantage of this offer. If chicken is offered at half price, then you might be thinking that this is a great price, and you will want to buy some supply for the freezer. Our human nature is such that we love a bargain. We love to seek out good offers and take advantage of them. It fills us with a sense of joy to know we have bought something which is cheap. Just yesterday I went shopping and there was an aisle with discounted items. Everything was half price or less. I bought soap and washing liquid and detergent for the next 12 months. As I filled the trolley, I laughed to myself, mostly because I knew that I would go on to write a chapter about this very behavior. It felt great to save 70% on stuff I knew I would buy anyway at some point during the year. Let's face it, we can save a lot of money if we shop contrary to the trend. If at all possible, I tend to buy my winter jackets when there is a heat wave outside. That is when the shops want to get rid of these items to make space for the summer clothes. Conversely, I love to buy my summer clothing when there is 6 feet of snow outside. I know it is not normal to do that, and maybe that is why I like doing it. I love a bargain. I don't think I am alone in loving to buy cheap. As I said earlier, the world of trading is diametrically opposed to the world outside trading. The traits I display as a human being outside my world of trading don't serve me well in the world of trading. This is not just me I am talking about. This is people in general. Our minds struggle to separate the world of trading from the world of general consumer behavior. Let's look at the differences. Supermarket bargain. When I see something in the supermarket that is cheaper than it was before, or that gives me a discount for buying more than one item, I am attracted to buying it. My action is driven by a subconscious drive towards pleasure. My action is that of a rational consumer who will seek out the cheapest products. The supermarket knows this, and they will tailor their offering to maximize my spending. My behavior is driven towards maximizing my pleasure, within my budget constraint. When I do so, it gives me a sensation of well-being. Financial market bargain. When I see the FTSE index falling in price during the day, my mind associates falling prices with value and becoming cheap. If I act on the impulse, one of two things will happen. 1. My feeling of value is confirmed. The market begins to rise. 2. My feeling of value is not confirmed. The market continues to fall. My argument is perhaps provocative, but no matter what happens next, I will end up losing, even if I win on the trade. If I buy with no good reason other than my mind sending me an impulse to say the market is cheap, I will lose if the market continues lower. And why would the market not continue lower? That is the premise of technical analysis. Trends persist. The market suffers from inertia, meaning that whatever it is doing now, the odds are above 50% it will continue to do. If I buy and the market begins to rise, I will eventually lose anyway, because I have now taught my mind that it is okay to stick my hand out and catch the proverbial falling knife. I have created a pattern in my mind that associates buying falling asset prices with pleasure, because I had success with it at some point. As a side note, when I began taking trading very seriously, I would review my trades when the day was over. I would print out the chart and plot my trades onto it. I realized that some 8 out of 10 trades were impulse trades. I began to become much more conscious of my trades. As I proceeded down that path, I became more and more profitable. The fewer impulse trades I had, the more money I made, and the more satisfaction I derived from my job. Self-analysis. Through analysis of my trading behavior, meticulously logging my trades on a chart after the trading day was over, I came to the realization that I was a prolific value trader. I would repeatedly short rising markets. I would repeatedly buy falling markets. It helps me to remind myself daily that when I am buying, someone else is shorting or getting out of a long position. A significant factor to my trading success, going from being a losing trader to a winning trader, was the realization that there are no bargains in the financial markets. Supermarket substitutes. When I am shopping for something in the supermarket and I discover a product has gone up in price, or a product that used to be on offer is no longer on offer, my mind will associate this with pain. My mind will direct me towards a substitute. This is perfectly rational human behavior. My sister and I laugh about this phenomenon. She lives in Germany and frequently travels with the airline EasyJet from Berlin. She puts it so eloquently when she says, "I will get up in the middle of the night for a 5 a.m. flight if it means I can save myself 25 euros. I think many of us can recognize this trait. Financial market substitutes. If something has gone up in price in the financial markets, then it means there is a demand for it. It may seem expensive, but it merely reflects the equilibrium point between buyers and sellers. I struggled with this for years. I argued it was expensive, and this faulty view was compounded by the technical indicators I was using. Indicators like stochastics would suggest a market was overbought or oversold. Those are other words for cheap and expensive. It is for this reason I am no longer trading with any kind of technical indicators. My charts are 100% naked. The perverseness of the financial markets is that it generally makes sense to buy something because it is more expensive today than it was yesterday. Dealing with adversity. When I experience difficult situations in my life, I will be patient and work on resolving them. Through my work and my resolve, I hope I will be able to solve the problem. I may even use force on the issue or use my authority to solve the problem. No amount of hard work, resolve, or prayer will turn a bad trading position into a good position. Either the market agrees with you or it doesn't. It doesn't matter how rich you are, how big and powerful you are. If the market disagrees, it disagrees. The market can only hurt you if you let it hurt you. The market will rally. The market will fall. Whether you are on board or not, making money or not, is inconsequential to the market. It knows nothing about you. When you make money because you are aligned with the market. The market itself is nothing more than the combined force of all the market players. They, like you, are looking to make money from trading. Unfortunately, we can't all make money. I came to realize after years of suffering that I had to change my relationship, not with the market, but with how I reacted to what the market did. Much of that process was undoing my life values and beliefs when it came to the trading world. In the normal world, when I don't get my way, I will work hard at convincing the other party to see things my way. I am very persuasive, and I usually get things how I want them. While that may be a trait that helped me in the real world, it is a trait that was detrimental to my trading performance. The market doesn't care about your position. It doesn't care if you are long or short or on the sidelines. The market has no feelings about you or your position. The essence of my argument is that many of the traits we display as perfectly normal people don't serve us well in the world of trading. I think all the successful traders I know have gone through a transformation process. Some were gradual, others talk about a specific situation which acted as a catapult to success. Some became so disgusted with themselves, they decided that they were going to either follow the rules or quit trading altogether. The innocence of objective observation. A very good friend of mine, Dr. David Paul, describes his own transformation in the following story. I have a PhD in mechanical engineering. I have worked for De Beers. I invented a mining drill which made me a fortune. I have had my own mining company. So it is fair to say that I came into the markets with a lot of confidence and a lot of money at my disposal. I started investing money in the 1980s. It was easy to make money in the stock market then. All you had to do was buy shares and then sit and wait. While I waited, I started doing programming on the early computers. I eventually created my own share selection software. It was incredibly sophisticated software for its time. On this particular day in question, the software called for the market to rise very strongly. So at the open of trading, I phoned my broker and placed a very large buy order. And sure enough, the market did what my software had said it would do. It started moving higher. I was naturally happy that the analysis was correct and that I was making money. I held on because the software predicted the rise would continue, only much more strongly. A short while later, however, the market began to drop. I was naturally a little surprised but knew that it must just be a temporary aberration and a good chance to buy a little more before the market really took off. So I did. I bought some more, and yet the market continued to drop. And drop. And drop. I began to get a little worried, so I phoned my broker and all my trading friends to see if there was any reason for this deviation. They too were at a loss to explain why the market was down. Their analysis had suggested the market would rally strongly. All the newsletters suggested that we were in the middle of a major wave 3 in Elliott wave analysis terms, and everything pointed to higher prices. I felt somewhat better having spoken to my friends and my broker about the situation, and I was sure that this was just an aberration. So I decided to buy a little more at these cheaper price levels. The market bounced for a while, and I felt pretty good about having bought some more at what I thought would be the lows of the day. The market then began to head lower again, and I began to get really concerned, even a little scared. It was quite a big position I had accumulated. Just then my wife walked into my office to ask what I wanted for dinner that night. She must have sensed that I was distracted or in discomfort, and she walked over to my desk and looked at the trading screen. "Is anything the matter, dear?" she asked. She can be so sweet. "No, my love, just working. My software says this market should go up." I pointed at the screen. The software has never been wrong, and I have spoken to the brokers and to my friends, and they all say that this market should be going up, but it is going down. She looked at the screen with the market and said, "Is this the market you are trading in?" "Yes," I said. "I really don't understand why it keeps moving lower. I'm sure it will move up very soon." "But it is not moving up right now, is it?" she said. I got a little impatient with her and I said, "No, dear, but what you don't understand is that the software and the Elliott wave count are in agreement. The market absolutely has to go up." "Oh, well, you are right. I don't know anything about this software or the Elliott thing, but it just doesn't seem to be going up right now, does it?" I distinctly remember taking a deep breath. I said to the woman I love, but who had now begun to irritate me, "No, dear, but just as soon as this passes, it will start to go up. It absolutely has to. I think this is just an AB equals CD formation. The software says so. The broker says so. My trading friends say so. The Elliott count says so. There is no way that all these people in my software could be wrong." "Okay, I am sorry, you are right. I don't understand your software or the Elliott thing or what the broker is talking about. All I see is that this market right now is going down, isn't it?" I stopped staring at the screen for a second and I looked up at my wife. "Could you please repeat what you just said?" She looked at me puzzled and said, "Well, I am just saying that right now, right at this moment, right here, right now, this market is moving down, isn't it?" And then it hit me like a thunderbolt. I wasn't trading the market. I was trading my opinion. I began to laugh because I felt for the first time that I knew what had to be done to make money in the market. I understood that the very thing I was trying to avoid was the very thing that was killing me right now. I was trying to avoid losing trades at all cost, and now I was in a trade that was losing me, only because I refused to listen to what the market was trying to tell me. I realized in that moment that I had to learn to lose in order to win. It was as simple as that. I wasn't trading the market. I was reinforcing my ego through the market. I picked up the phone, called my broker, and sold out all my long positions. Furthermore, I sold a large number of contracts short as well. And sure enough, the market continued, down and down and down. My trading life changed that day. I no longer paid so much attention to expert theories, and I stopped guessing where the market was going. I started trading the markets. It was a revelation. I started making lots of money. I realized that some of the stuff I had read was outright wrong and detrimental to my trading. For example, we have all read the axiom of buy low and sell high. I changed that to sell low and cover lower, and buy high and sell higher. Surrender. When I asked David to sum up his experience, he said to me, "Look at your own life. You love to surf. You wait for the waves, and you paddle into their energy flow, and you ride the wave. How is that any different to what we do as traders? When you are out there sitting outside the impact zone, waiting to paddle in, you don't paddle when there are no waves. You are patient. When the right size wave builds up, you get ready. You are one with the sea. You roll with its flow. You surrender." To succeed in the markets, we must surrender. Every single individual on planet Earth has a great deal of time, money, and value tied up in what we know, and it is unthinkable to even consider surrendering all this perceived knowledge. The purpose of my trading and your trading is not to be proven right and bolster our egos. Our job is to make money. If that means we come to the market with an opinion, and we are proven right, so be it. If it means we have to change our opinion because the market dictates it, so be it. A more spiritual person than I would perhaps express this as, empty your mind and let the market guide you. There is a lot less to trading than meets the eye. The fact is that our complicated human minds have a great deal of trouble processing information that is simple. Unless it is complex to the 10th degree, our minds tend to pass it over. We think that something simple can't be profitable. What is your aim? The simple answer should be to make money. In the past, I was so preoccupied with what should happen. But to make money, we must be focused on what is happening right here, right now. When I started writing this book, I wanted to keep it practical. I had no interest in trying to pass myself off as a trader therapist or a psychologist, because I am not. I wanted it to show the true nature of what trading is, written by someone who has skin in the game and who has both scars and medals to show for it. If the last few pages have been a little too theoretical for your liking, I would like to describe a real-life case study, one that was captured on video, my way of telling you that this is an authentic story, by Round the Clock Trader in July 2019. I want to explain what I mean by going into the market with an open mind and an empty cup. I bought an index after a double bottom. Everything looked pretty good. I was long from 12,808 and I had bought again at 12,818. Then it happened. The index plummeted. My 5-minute chart showed 3 major lows. I call these get-out bars when I am trading against their direction, or add 2 bars when I am on the right side of them. I was wrong being long. I got out of my long position and reversed my position to short relatively early on in the downward spiral of the index. There were some 500 traders attending the event, and what pleased me most about the outcomes was not that I lost on my first trade, or that I won my money back soon after. What pleased me most was that I did not stubbornly hold on to a losing trade, and that I had the mental freedom to move from being long the market to now being short the market. When I started trading, there was no chance in hell I would have done what I did there. I would have held on and held on to that losing position. I know I am right, I would have said, except I wasn't, and I wasn't making money. The most critical point came when my new short position showed a profit, which was equal to what I had lost on the long position. My mind desperately wanted me to bring balance to its emotions. What better way to do that than to offset the loss from the first trade? Well, in the words of my greatest trading hero, Charlie DeFrancesca, good trading means combating the emotions that make us human. Let's take a look at how we can do that.